up very well. It is showing still a near 2 job openings for every unemployed worker in the U.S. You can just see how that stands out versus the pre-COVID trend. This chart goes back nearly 10 years, just how elevated that is to history. But there was one soft thing in this print, which I want to shout out to you, Tom. It was job openings in the construction sector specifically. Those have dropped. Now, the data has been volatile recently, but the trend is lower, and this number is pretty in line with where those job openings were pre-COVID. So again, where are these rate rises impacting the U.S. economy? It's showing up in the housing sector, and both in house prices, housing activity, and in job openings in the construction sector.
Okay, that's really important, of course, around the centrality, the importance of the real estate market in the US. There was a remarkable anecdote from the Beige Book, of course, around one firm flying some construction workers on a private jet because they couldn't get the right kind of employees in the area that they were looking to build. But as you say, broadly, construction jobs coming off. Maybe a little bit of relief there then for the Fed on that point. Valerie Teitel, our markets reporter, thank you very much indeed. Let's bring in now Raffaella Tenconi, chief economist and founder of ADA Economics. Raffaella, good morning. Thank you for joining us. Your assessment then of the messages, mixed messages arguably, from the Fed chair, Jay Powell. The market's still looking to, as Valerie was saying, 40 basis points at least come March the 22nd. You were out front in calling for higher rates last year. What is your assessment now of the terminal rate?
Hi, good morning, everyone. Yeah, I think the tone is mixed because data dependency at this juncture, I think it makes sense. And I also think the Fed, like most central banks, is not yet clear on how to handle the long-term structural trends that impact the labor market and the inflation. So our current guidance is that the peak in rates for Fed funds will be 550, but we have been signaling since last fall that 650 is completely plausible. The difference between these two is really what the Fed decides to do with the housing market. At 550, and is what we observe currently, the housing market is weak in volume, but it's still high in prices, so it is inflationary. If you want to go to 650, what you're doing is you shock it, and that will trigger probably a price correction already now and gives you an immediate relief on inflation. It caused problems, though, between from 2024 onwards, but it's a personal preference of the Fed.
Are we closer to a policy mistake today than we were last week, Raffaella?
Not necessarily. I think what Powell said in his testimony, that today he doesn't see any evidence that they've overdone it, it's technically correct. But from an economist perspective, I think when you fast forward, it's clear that at 550 they've done enough. Okay. But the problem that I see is, first of all, the communication to the broader public is weak. The broader public, essentially what you can see from consumer surveys is that the public understands what the governments say, which is we need to do these big transitions on defense, on reshoring, on energy. It is labor intensive, it is investment intensive, it is inflationary. So the broader public understands that the central bank will act but not kill the economy. The central banks, in hiding behind the forecast, is essentially confusing the picture, and it's undermining the long-term transition. So there is a very real risk that we make a policy mistake, especially if we don't clarify the communication, I think.
Okay, so to be clear, your base case is 550, 5.5%, but 650 is certainly in the cards. What would that do? Would that kill the economy of the US, at least in the next 24 to 48 months?
Yes, it would trigger a recession. It would trigger a significant downturn in the housing market, so house price levels will drop. And it would also trigger a balance sheet consolidation in the non-financial corporate sector that at the moment we don't really expect. We expect some softening in profitability, but we don't expect balance sheet consolidation like in 2008. At that point, I think it becomes very important what you do in 2024. So we think the Fed funds should go to 3 in 2024, which is, it gives release to the economy. It's still tight, so it adjusts for the higher inflation base, so to speak. But if the Fed were to go to 650 and then stay at 4, which is the dot plot recommendation, then I think that is a massive policy mistake.
Okay, so you're projecting out to 3. Of course, the Fed has 4% for next year, and the policy mistake risks of 6.5. Just briefly, Rafaela, and you nodded to this, is there a misunderstanding amongst these central banks, the Fed and others, around some of the structural supports that we're seeing for the labor market at this point?
Yeah, I think that there is a part of a weakness in analysis and a part of weakness in communication. So the fact of, because of these massive transitions at a time when the labor market is already tight, essentially keep the labor market incredibly tight, and wage pressures will remain very high, on top of the fact that digitalization is de facto inflationary right now. So what you should be doing is acknowledge that you have uncertainty, but de facto you're looking at an economy that in the next few years will need a tighter labor market and higher inflation than the target. So you need to acknowledge that you cannot possibly deliver the inflation target. You can deliver a moderation and you can guide the transition. So what I see is most central banks have a department for climate change, so to speak, but that department is not communicating with the main forecasting department yet. I've seen this mistake before. It is going to take time, and I think it takes courage, because most central banks are afraid the market will panic, essentially, when they're transparent.
Okay.
Whereas I think the market appreciates transparency.
Rafaela Tenconi, chief economist and founder of ADA Economics, stays with us. We'll get her views on the ECB and the BOE in the next couple of minutes. Let's check in on some of the individual corporates on the move, some of the individual stocks on the moves. Credit Suisse back as one of the most read stories on the Bloomberg once again on the news that it has delayed, the Swiss lender, the publication of its annual report and compensation details for 2022. This after a late-minute request, queries and questions from the SEC in the US on Wednesday night. Questions about cash flow statements related to the financial years of 2019 and 2020. Credit Suisse currently down 2%, and we'll bring you more details on that story later this hour. Dassault Systems, in fact, Dassault Aviation, that is the stock that is in focus for us today. The maker of Rafale and Mirage aircraft and private jets like the Falcon. Net sales beating for the full year, beating the estimates, close to 7 billion euros. Continues to watch that stock for you. And Aviva, listed here in the UK, gaining 3%, full-year operating profit, beating the estimates, £2.2 billion. Yes, it was down 2.3% year on year, but it was well above the estimates of 1.8 billion. So a solid beat there for Aviva. Now, coming up, US President Joe Biden will unveil his budget plan later today, setting the stage for his fiscal battle with Republicans ahead of the 2024 election. We'll bring you the details. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Next week, Balance of Power is on the move. Starting Monday, March 13th, Balance of Power debuts at 5 p.m. Eastern Time, live from Bloomberg's Washington headquarters. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis at the intersection of politics and business. Balance of Power, Weekdays at 5 p.m. Eastern starting Monday. Only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 13 minutes into the European trading day. You're seeing losses across the benchmark of 0.3% here in Europe after very modest gains yesterday. Futures in the US also pointing lower. The S&P E-mini is down 0.2%. Yields up on gilts, bunds and BTPs as investors readjust to views around the Federal Reserve. Jay Powell trying to soften the tone around the March meeting decision. But the JOLTS numbers, the job opening numbers, pointing again, reminding us of the hot labor market in the US. Staying with the US President Biden is proposing a series of new tax increases on billionaires, rich investors and corporations in his upcoming budget. Sources tell Bloomberg the proposal will call for a 25% minimum tax on billionaires. Joining us now is Bloomberg's Bruce Einhorn. Bruce, what else is President Biden proposing?
Well, Tom, this is part of the budget proposal that will come out today, Thursday, in the U.S. So in addition to the 25% minimum tax on billionaires, the White House is also proposing raising the top tax bracket on incomes over $400,000 to 39.6%. Also about doubling the capital gains tax, also to 39.6%, raising the corporate tax rate from 21%, to 28%. So these would be reversals of some of the changes that took place during the Trump administration. This is on top of already announced tax increases that the president is proposing for payroll taxes to fund Medicare. Tom.
Here's the thing, though, Bruce. The Republicans are in control of the House. They're not going to let this pass, are they? What are the chances of Biden getting all of this, any of this, through?
Not great. These are proposals that the White House wasn't able to push through when the Democrats controlled both houses of Congress. So certainly they're not going to be able to pass it when the Republicans control the House. What's important here is it does underscore the huge gap between the two parties. The Democrats, the White House, proposing tax increases. The Republicans have talked about making huge cuts in spending. They haven't laid out what those cuts would be. As we saw during the State of the Union address, the Republicans got very upset when President Biden said that there were some of them who wanted to cut Social Security and Medicare. So that now seems to be off the table. They haven't really laid out where they do want to make cuts. And that's something that the White House is looking forward to in the weeks, months ahead. All this, of course, is leading to potentially the breaching of the debt ceiling sometime this summer, as well as a possible government shutdown in the fall. The two sides are going to have to come to some agreement in order to avert those two things later this year.
Okay.
But as we see right now, there's still quite a gap between them. Tom.
Bloomberg's Bruce Einhorn on those budget proposals from President Biden. Thank you very much indeed. Let's bring back in Raphael Tenconi, then Chief Economist and founder of ADA Economics, still with us. We've touched on the US already, so let's take it to what's happening with Europe and the ECB, Raphaela. The divisions within the governing body are really quite pronounced. They're quite remarkable. The comments most recently from Bank of Italy's Visco really lashing out at the hawks within the ECB around data dependency. Does this concern you? Are these usual healthy debates within the governing council of the ECB, or does it point to more dangerous fissures?
Well, I think healthy debate is good. Definitely, there are complex issues that we face. I think member states have different starting points anyway, so I think transparent debate makes sense. In any case, I think it's well understood that the majority of the council is not as extreme as some of the recent comments that we've seen. And I think the two are trying to convey a message that perhaps from Madame Lagarde is not completely clear. So one message is the interest rate in the Eurozone has to be higher than in the past because we essentially need to fund the transition. The investment transition needs a higher interest rate. When you look at the balance of payments of the Eurozone, it's still showing that portfolio investment is soft.
Yeah.
So,
but where does that, Raffaella, where does that higher rate take you in terms of your forecast?
So we think the ECB could go to 4 for the main refi rate. But if it goes to 4, then probably it settles at 3 in 2024. Essentially, anything around 350 is appropriate. Anything above 4% becomes really systematically problematic for the Eurozone, because you would have massive problems in controlling the yield curve in the Eurozone, and you would stop the transition.
What is the most vulnerable part of the Eurozone economy right now?
Well, in terms of member state, it's clear that Italy is the one that has high gross funding needs, and it's quite delicate as it's a barometer of the health of the union. So this is the problem with going above 4%. You know, I mean, the BTP is well anchored up to 5% in the 10-year leg, because Italy is increasingly funding itself through retail bonds. So it can handle 5%, but above 5%, I think it stirs panic. In terms of sectors, I think the housing market in the Eurozone is highly valued. It's supported by portfolio reallocation of families and the cost of the green transition. But de facto is an asset that is slightly overvalued in some places. So that, I think, is a weakness of the union.
Okay, 449 currently on Italian 10-year BTPs. That's a move higher by 6 basis points just in the session today. Raffaella, on the UK and the Bank of England and the divisions there equally as pronounced as they are within the ECB governing body, particularly around Swati Dhingra versus Catherine Mann, the hawks and the doves, or the doves when it comes to Swati Dhingra versus the hawk of Catherine Mann. Who do you think wins that debate?
Well, this is a tough one. I still think the Bank of England is fundamentally more of a dovish entity than a hawkish entity. And I think the UK has an even bigger problem than the Eurozone on the labour market, because it urgently needs to clarify the legislation to allow the labour market to be as flexible as it used to be before Brexit. Otherwise, the UK has a real stagnation problem. So I think until the politics sorts itself out, the Bank of England remains more dovish than hawkish.
Okay, Raffaella Tenconi, really, really interesting insights across the Fed, the ECB and the BOE. Thank you very much indeed, Chief Economist and founder of ADA Economics. Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Bloomberg has learned that former Treasury Department Chief Economist Janice Everly is the frontrunner for the next Vice Chair of the U.S. Federal Reserve. The Northwestern University professor is said to have met with Treasury Secretary Janet Yellen, as well as President Biden's Chief of Staff. Sony has urged the UK's antitrust watchdog to block Microsoft's $69 billion Activision Blizzard takeover or force it to sell blockbuster game Call of Duty. The PlayStation maker says no other solution exists that will prevent harm to consumers in the cloud gaming or console markets. Microsoft says the deal cannot be completed without Call of Duty. Never mind the S&P, the price of second-hand luxury watches has soared an average of 20% a year since mid-2018. According to Boston Consulting Group and secondary market dealer Watchbox, pre-owned Rolex, Patek Philippe and Audemars Piguet watches gained in value by almost twice as much as the US benchmark over the period. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg. Tom.
Laura Wright, thank you very much indeed. Love that story. Dust off your watch collection. It's done better for you than equities. Right, coming up, Apollo Global Management CEO and co-founder Mark Rowan spoke to Francine Lacqua on his thoughts of whether we will see a recession ahead. We're going to bring you more from that exclusive conversation. That is next. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think we're in a no landing, or as I've been jokingly saying, I think we're having a non-recession recession. And what I mean by that is you think about what happened in the U.S., we printed $8 trillion. Are we surprised by what happened? We shouldn't be. Everything went up and to the right. Last year, we started to withdraw some of that stimulus, and lo and behold, things went down. But everyone who wants a job has a job. Unemployment is at record lows. The last cycle was about even lower ends of the employment spectrum in restaurant and hospitality. And so when I say no recession, those who are in asset markets or in financial markets, it feels like a recession because everything is down. But for the vast majority of certainly Americans, but also around the world, people have jobs and they're spending.
In general, where do you see actually distress? So we know that there were, questions about, for example, Blackstone and REITs. Does it change the way you structure and sell the product?
It doesn't really. And, as much as it's easy to take a shot at a competitor or someone who's in the same industry, they're actually doing exactly the right thing. They are paying the tuition for the industry to explain to investors that alternative has a cost. Alternative means you're going to get more return, but you're going to give up some amount of liquidity. And investors need the education to understand that the money they allocate to alternatives, whether they're alternative equity, alternative REITs, or alternative credit, is less liquid than in public markets.
But are there parts of that alternative market that you worry about for the next 12 to 18 months?
I don't really. I don't see the kinds of excess. So we had, if you go back to 2007, we had a period of excess, far greater than what happened in this most recent excess. The excesses in 2007 were funded with leverage. The excesses in 2021 were funded with equity. So I believe that while we will have some amount of distress, I don't think the distress cycle will be anything like what we saw in 2008. And I think most of the pain is actually going to be borne by equity.
And that was Mark Rowan, CEO of Apollo Global Management, speaking to Francine. Of course, coming up, we are joined by Bank of America Chairman and CEO Brian Moynihan, live from their Paris Global Investor Summit. That exclusive interview is at 9:30 a.m. UK time. Let's briefly check in on the movers, the stocks to watch. Credit Suisse, of course, in focus for us again today on the back of reports, the news that it has delayed its annual report after a late query by the Securities Exchange Commission in the US. That stock down 3.4%. It was a beat for Dassault Systèmes, the maker of fighter jets, fighter aircraft, but also private aircraft, rallying close to 10%. Aviva also beating on results, revenue coming in higher than estimates, gaining 3%. Dassault Aviation is the stock in focus there, gaining 9.7% on the back of stronger earnings. Coming up, we're going to talk China. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with their head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
This is Bloomberg.
Welcome back to The Open. We are 30 minutes into the European trading day, and here are your top stories. Investors weigh Jerome Powell's softer tone on rates amid job openings data showing the labour market remains tight, and weaker inflation readings in China. President Biden is proposing a range of tax increases on billionaires, rich investors and corporations as part of his budget to Congress, plus Credit Suisse slumps as the embattled lender delays publishing its annual report and compensation details for 2022 after last-minute queries from the SEC. How many times have we referred to Credit Suisse as an embattled lender, and will we do so again? That stock remains in focus for us today. Across your benchmark, European stocks down 0.3%. Yes, Jay Powell moderating to some extent his views, his language around the likelihood or not of 50 basis points come March the 22nd, saying that decision has not been made. The labour market, of course, remaining tight. We have the non-farm payrolls out Friday. Maybe a little bit of optimism when it comes to global inflation, given the softness we saw in terms of producer prices and consumer prices out of China. But of course, it also does reflect a weaker economy there. The DAX currently down 21 points. The FTSE 100 off by 0.5%. Basic Resources is a drag there, as we'll see when we switch it over and have a look at how these different sectors are playing out. Worth pointing out, yields are up, by the way, in bunds, gilts and BTPs over in Italy. Insurance just gaining 0.2%. Aviva is playing a role there, coming in with better than expected earnings. Food and beverage up 0.1%. Telecoms, a bit of a switch to safety, just gaining about 0.1% as well. But every other sector in the red, as I mentioned, led by Basic Resources, down 1.9%. You can tie that very squarely to those softer than expected producer prices out of China. Let's stay with the China story then. China's consumer and producer prices did remain subdued in February as food and commodity costs ease, suggesting the country's reopening may not add to global inflation pressures. We're now joined by CraneShares UK Head of International, Xiaolin Chen. Xiaolin, good morning. Thank you for joining us. So we have the data that's come out, of course, on the week that the NPC has been meeting in Beijing. I want to start with the performance of the equity markets, though, in China. The rally that we had post-October fading into this year. Year to date, the CSI 300 gaining about 4%, underperforming European equities, underperforming US equities. Has the market reopen play around China come to an end?
Good morning, Tom. Thank you for having me. I certainly understand, the data came out slightly weaker than expected, mainly driven by food components that are significantly adjusted to lower. This is more of from the seasonal high of January. When there's a new year and Chinese New Year, food price surged quite significantly. Now it's pulling back as a seasonal adjusted factor. So it's understandable CPI are coming slightly lower in February. Answering your question, if equity is losing momentum, I think it's on the other way around. In fact, like you said, in October or since October last year, equity market has rebounded very, very sharply. A lot of the global fund managers particularly are still underweight to China. That rebound, some of the sector, like the internet sector, rebounded over 97%. That is a very painful trade for active manager on a relative basis. You have seen some pullback, probably on two factors, waiting to see one, what will come out from NPC, two is some profit taking. But at the same time, you also see investors slowly, gradually phasing in to close that underweight, that painful trade they have on China equity.
Yeah, certainly. You wouldn't want to be shorting, particularly from October through to December, some of the big tech names in China, would you? But when it comes to the catalysts, Xiaolin, for the next 3, 6, 12 months out of China, what are the catalysts that are going to pull that foreign money back into Chinese assets?
Policy matters in China the most. So a lot of eyes are on NPC. Obviously, now they are going through all the proposals of different reforms, policies, so on and so forth. At the moment, they are approving all the proposals. We'll hear more in the coming days, what will get approved, what will get introduced. That is very important. We have already received some guidance on GDP, which is quite in line with the market expectation, around 5%. Physical spending, 3%. I think that's quite moderate, slightly on the upside, but moderate. The other policy you want to wait and see and hear and confirm is what are the concrete policies to support the corporates. From the statement or from the meetings and conference happened in December, if you remember, Tom, is highly signaled to consumption will lead the way, private sector have to create the jobs, and internet and platform company would have to go back to become more competitive at the global stage. I think those are the guidance you have received. Fundamentally, equity market is not pressing in the good fundamental earnings.
Xiaolin, I just wonder what the impulse is going to be coming through from Chinese households. UBS pointing out that Chinese households have about $1.1 trillion, 1.1 trillion in terms of excess available deposits. But others, fund managers like PineBridge, saying we shouldn't bet on the impulse coming through from Chinese households. They've been scarred by the pandemic. And of course, you have a jobless rate, urban jobless rate of around 20% for under 25s. How do you square those two things?
Young job, the unemployment rate is referring to young people, the unemployment rate. That is very relatively easier to fix, in my opinion, because it's a 16 to 24, slightly at the lower value chain job need to create it. If NPC come out of more budgeting spending on green infrastructure, Tom, that can be fixed quite quickly. That's number one. Number two, Chinese household did, search or saved a lot more during pandemic lockdown. In 2022, Chinese household bank deposits raised 80%, 80%. If you use US as indication, during pandemic, US household also saved a lot more during pandemic lockdown. Once that finished, that spending start to happen, bank deposit going down. So if we use that as an indication, we see tourism, we see overseas holidays, and then luxury spending is all picking up. So we do stay optimism. The consumer power is stay intact in China.
Okay, so that's the consumer play, and you're clearly constructive on Chinese equities for year ahead. How do you play that, Xiaolin? What are your preferred sectors, your preferred themes?
We prefer the most is which sector get oversold, overbeaten because of the macro factor. But now the macro factor becomes supportive and accommodative. That's consumption. That's internet and platform companies. That is our play. And most importantly, it has a huge leeway runway of the savings we mentioned, and also, Tom, the unique client, unique customer base in China is the 870 million people who live in city today. Those are the foundation and fundamental for consumer power in China. So we stay very optimism of consumption-led recovery in China.
To what extent does that positioning shelter you from the geopolitics?
Geopolitics is important in many ways that will impact the macro factors. If you look at the various indicators on geopolitical attentions, that today is the geopolitical is around, I think it's around 60 to 70%, still factoring in the geopolitical risks, but that's come down from 96%. Most of the internet and platform companies in China has a high percentage of revenue over 90+% of high percentage revenue is actually from domestic economy. So they are less impactful by external factor.
Okay, Chen Xiaoling, thank you very much indeed. CraneShares UK International Head on the opportunities around the Chinese consumer internet platforms and the digital economy. Thank you very much indeed. Now, Bank of Japan Governor Haruhiko Kuroda is leading his final policy meeting, which kicks off today. He's due to step down next month after the longest stint running the central bank in its 140-year history. Here's a look then at how Kuroda spearheaded the most ambitious monetary stimulus program of modern times.
Haruhiko Kuroda took over as governor of the Bank of Japan in March of 2013. 2 months before Kuroda took over, the BOJ signed a landmark accord with the former Prime Minister Shinzo Abe to reach 2% inflation in the shortest time possible. After being sworn in, he committed to a 2-year deadline to reach that target and introduced his bold strategy called quantitative and qualitative easing, the first step in what soon became known as his monetary bazooka. A year later, Kuroda fired another shot, the infamous Halloween surprise, shocking markets as the BOJ nearly doubled its yearly bond purchase target from 50 to 80 trillion yen. In January of 2016, the BOJ narrowly voted to cut its key rate to negative 0.1%. The public backlash was immediate and fierce. 8 months later, the BOJ adopted its most innovative step of all, yield curve control, tying the 10-year Japanese government bond yield to zero, and becoming the first central bank in the world to take this radical monetary step to spur inflation. By the time Kuroda was reappointed, inflation was above zero, but it didn't reach the 2% target. Kuroda then fine-tuned YCC by allowing it to move around double the rate of 10 basis points on either side of zero. In early 2021, concerns were growing after the BOJ became the biggest single holder of Japanese stocks. By September 2022, a weakening in the yen helped boost the BOJ's key inflation metric, reaching 4% by the end of the year. 3 months later, Kuroda rocked markets once again with a surprising decision to widen the 10-year yield band, doubling it to 0.5%. By 2023, investors are already betting some of his ultra-loose policies will be dismantled before long. How history will judge Kurodanomics is still uncertain as a new team prepares to take charge of the BOJ.
Bloomberg's Kathleen Hayes there looking at the tenure, the legacy of the outgoing BOJ Governor Haruhiko Kuroda. Right, coming up, Credit Suisse shares fall as the bank delays the release of its annual report. We bring you the details on that and the implications. That is next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 point. Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, Friday on Bloomberg Television and Radio.
Welcome back to the Open. We are 44 minutes into your European trading day. The sentiment just very modestly, it seems, getting a little less dire. Down 0.2%, but the sell-off in bonds and gilts and bunds and BTPs is moderated to some extent. Futures in the US, though, down 0.2% on the S&P E-minis. One corporate story back central, and in terms of our attention, Credit Suisse trading lower this morning after the bank says there will be a delay in the publication of its 2022 annual report. This comes after the SEC raised a last-minute query on previous statements. To unpack the slew of stories from the banking sector, we are joined by Tom Metcalf, Bloomberg's finance reporter. Let's start in Europe, and the question around Credit Suisse. I mean, just day after day, week after week for Credit Suisse, another embarrassment. How damaging is this potentially?
Yeah, well, like you say, Groundhog Day, right? So shares are down. I think, you know, the story itself, it strikes me as more of a technicality. It's relating to the 2019-2020 cash flows. And certainly the bank is messaging that, you know, look, our 2023 results in terms of the financials, they're not changing. We just need to delay the report, you know, the full annual report, just so we make sure we've kind of dotted our I's, crossed our T's. But any questions around accountants, you know, investors are going to hate that, hence the shares are down. And it's more like cumulative, right? Again and again, we're on here talking about Credit Suisse just can't seem to catch a break, and hence the shares are down.
Drip of bad news. Currently down 3%, even as you say, the implications may not be as severe as maybe it would be suggested. Meanwhile, on the jobs front, overnight we had some carefully worded comments from the CFO of Citigroup. Take a listen.
We've been doing lots of hiring over the past couple of years. We've really been trying to build out in areas where we've had either a competitive advantage or an area we think suggests significant growth opportunities. So we've been investing in investment banking.
All right, so Tom, should bankers, should employees at Citi, should they be worried?
Yeah, it's a fascinating word in there. He was using sort of phrases like calibrate, repace our hiring. The way I interpret that, it sounds like there might well be more sort of job losses coming in, particularly in investment banking. You know, this is the big trend across the industry. Deal making is just really not happening right now. So it's interesting to hear it, and interesting to hear but how carefully couched it was. So lots of wiggle room there. But yeah, it does sound like more bad news ahead for investment bankers.
Okay, meanwhile, another huge story within the banking sector, really, really fascinating. JP Morgan suing former executive Jez Staley for Epstein dealings. What do we know?
Yeah, so basically in the US, there's a lot of lawsuits going on against JP Morgan saying because they basically banked Epstein, that they are sort of liable for damages to Epstein's victims. What JP Morgan have come out and said is, you know, we don't see these cases having any kind of viability, but if they do, then the person who should be suing is Jez Staley, who ran their investment bank, investment bank during those years. And, you know, Jez Staley, former CEO of Barclays, you know, he's gone aground. Haven't really heard a response on this yet, but it is really interesting big news because it's just going to suggest what is going to happen next. What's the next shoe to drop? Will Staley, for example, respond to this? Is he going to keep quiet on it? But it's very, very interesting, and it goes to show, I think, just how sort of serious JP Morgan is taking these lawsuits. You know, they're not just trying to dismiss them out of hand; they're trying to almost shift the blame, really.
I mean, this is a deadly serious issue, isn't it? So the lawsuits, the lawyer's been kept busy on multiple fronts on this story, and we'll keep across it, of course. Tom Metcalf from our finance and banking team, thank you very much indeed, hitting a number of stories across that sector. Let's get to the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. President Biden is to target billionaires and rich investors in the budget request he unveils later today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would also be raised, including a big hike in the capital gains rate for investments. The proposal has little chance of passing Congress, however, with Republicans now in control of the House of Representatives. The Netherlands is preparing restrictions on the export of some chip-making machines to China amid pressure from the US. According to a letter to Dutch lawmakers, the plan adds to existing curbs on the sale of advanced chip-making machinery. The country is home to ASML, the world leader in high-tech chip equipment. Several Ukrainian cities have come under fire from Russian missiles overnight. Kyiv says energy facilities have again been among key targets. Meanwhile, intelligence chiefs in the US have told a Senate committee that Russia is likely to downgrade its ambitions in Ukraine for now to hold territory seized since the start of the invasion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg. Tom.
Okay, Laura Wright here in London, thank you. Coming up, Silvergate falls victim to the crypto market turmoil. That's as the bank enters voluntary liquidation. We've got more on the fate of this bank, what it means for the broader crypto sector and indeed the financial sector. That is next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
It was going to keep rainwater cup. This is a 3.
As the economic picture does.
Is it the OK is getting ready to make this decision?
If you want to solve inflation, according to their rule book, you've got to keep on raising rates. And of course, don't forget, there's a political element here. They don't want to damage the Biden administration by raising rates too much and killing the economy. So it's really a conflict. And I would say that they're going to continue at this path in being very careful about raising rates, but at the same time, once the election is over, then they'll go full gun and raise rates to where it will have some impact.
Okay, veteran emerging markets investor Mark Mobius there on the Fed's inflation fight. We are 53 minutes into your European trading day. You're seeing losses now 0.4%. It's been a choppy session in these first 53 minutes or so to the industry. Editor Anna Herrera. Anna, what does this mean? Are there broader implications as a result of this liquidation for the wider crypto sector?
Yeah, for sure. Crypto has always had a banking issue in the sense that it's struggled to get bank accounts, which is a problem because even though they're trying to remake finance, they need to settle trades and payments. And Silvergate had a payments network, which is very important for crypto firms, and that's going to stop working. And so the question is, how do they settle payments now? Who becomes the next big crypto bank? So it is a big problem for crypto to figure out how do they go back to the days when they were like settling. I'm not sure how. They used to trade on Skype. So, yeah. You know, it's interesting.
Going back to trading on Skype, that'd be quite something, wouldn't it? What does it, we ask you this every time you're on, but it's a valid question. Is the contagion over yet?
Yeah, I'm like a bearer of bad news. Every time I come, there's like there's some other bank going down. Yeah, crypto firm.
On crypto.
Yeah, so I mean, the question now is maybe not if there's more FTX contagion or if there's Silvergate contagion, but, you know, trading volumes continue to be down. You know, we had a little mini rally, but the volumes are nowhere near what they were before. Can exchanges sustain these low volumes? You know, they make money off fees. Fees are down. Like, that's the big question next. Who can continue to survive with this low sort of trading environment and in more broadly in a macro environment that isn't very favorable to crypto?
What is the sense you're getting from institutional investors? Some have dipped their toe into the crypto space. Is that move now dead in the water, or is there any sense they might be coming back?
So if you speak to people on Wall Street and people in finance, they're now more interested in the tokenization of real world assets. So we're not sure if that's another buzzword and it's another narrative to like drive crypto prices up. But, you know, the people that had made a move aren't necessarily going away because it just takes them so long to move that they probably thought about it in a longer term horizon. So we'll have to watch for that. But obviously, you know, US regulators have been worried that there could be a collapse in traditional finance due to crypto, and this is sort of like an example of it. So it might make it a bit harder for them to jump right in. Regulators might be a bit more wary this time.
And you've had lawmakers on Capitol Hill saying that the SEC and others missed the ball on Silvergate. Whether that's valid or not, we'll leave up for debate, but certainly it's a fascinating story. Anna Herrera, thank you very much indeed on the latest in terms of liquidation of Silvergate, what it means for the crypto space. That bank has been in the business since the 80s, but really moved aggressively into crypto in around 2013. Let's check in on some of the individual corporates to bring to your attention. Again, of course, Credit Suisse remains in focus for us. That stock, look at that, down 3.7%. The news that the Swiss lender has delayed the publication of its annual report and compensation details for 2022. Talking of the SEC, that's because the SEC gave them a call, it seems, on Wednesday evening, asking for some details about financial reports and financial statements, cash flow statements from 2019 and 2020. Dassault Aviation rallying close to 11%, 10.5%. This is the maker of Rafale and Mirage fighter jets. They came in with earnings that beat results. Aviva, the insurer based here in London, gaining 3.4%. Full year operating profit beating the estimates, £2.2 billion, well above the estimates of 1.8 billion. Also a higher dividend and a share buyback program of 300 million. Investors rewarding those better than expected results out of Aviva. That is it for the European Market Open. Surveillance early edition is up next. Markets here in Europe currently down 0.3%. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
The top names in business are on Bloomberg.
AI is real. We're already using it to do risk, fraud, marketing, prospecting, and it's the tip of the iceberg. This is extraordinary. And the other thing to keep in mind, there's good use, but bad guys are going to use it too. So it's a little bit of an arms race in how you have to use it to protect your company, protect your clients, protect data, et cetera. And we're fully engaged.
Nobody covers business like Bloomberg, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming on today's programme. Stocks and futures are mixed as traders weigh Jerome Powell's softer tone on rates and weaker inflation readings coming out of China. Credit Suisse delays publishing its annual report and compensation details for 2022 after last-minute queries from the SEC. Plus, Paris in the spotlight after Brexit. Our exclusive interview with the Bank of America Chairman and CEO Brian Moynihan. That is live from the Lenders Global Investor Summit in the French capital. Francine Lacqua bringing us that exclusive, of course, in the next 30 minutes or so. Let's check in on these markets. Yes, Jay Powell moderating his tone when it comes to that decision around March the 22nd, saying a decision has not been made. They need to see the data. But still, 50 basis points is still in the cards for many investors. The market's expecting at least 40 basis points in terms of that decision coming through March the 22nd. Of course, the jobs numbers, the JOLTS data coming through very hot again yesterday. The job openings just underscoring the challenge around the red-hot labour market for the Federal Reserve. The linkages as well for them between the jobs markets and the services sector and inflation there. How to get that down remains a conundrum. Of course, here in Europe, we continue to weigh up the commentary from a very divided ECB as well. And you heard from the Italian central bank governor there, pushing back really on the hawks and saying that we really need to be data dependent. Across these European markets then, a drop of 0.4%. It is worth flagging the data that came out of China in terms of inflation, because the inflation impulse is coming soft. So that idea, that fear that maybe a reopened China will lead to an accelerated inflation picture globally is not coming to pass, at least for now. So possibly that's a silver lining. Futures in the US pointing lower by 0.2% after some very modest gains on Wall Street yesterday. The Japanese yen is lower by 0.7%, 136. Of course, the central bank governor of Japan, Mr. Kuroda, will be wrapping up his final meeting as head of the Bank of Japan. Will there be any surprises in store? We continue to watch that story for you. Bitcoin 21,680, down 1.5%. Silvergate, the bank over in California, very exposed to all things crypto, is liquidating, of course, as a result of the fallout from FTX. Now, we got a somewhat different tone, of course, from the Fed Chair Jerome Powell, as I mentioned, on his second day of testimony to Congress. Powell saying his team will wait for fresh data before deciding how much to hike rates this month.
We have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook. No decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Okay, for the analysis, let's bring in Bloomberg's Justina Lee. Justina, help us make sense of what's happened over the last 48 hours in DC from Fed Chair Jay Powell. Hawkish, very hawkish, surprisingly hawkish. And then he comes out and moderates that message. Did he regret the comments around 50 basis points, around moving higher in March? What is the view? What is the commentary? What is he trying to message to markets and the wider public?
I think ultimately what he was trying to say is that the Fed is still data dependent. But if you look at like the totality of his comments, I mean, the takeaway is still hawkish. It's still the fact that the Fed is very determined to curb inflation. And they're not just looking for hints that inflation has started to slow. They're looking for a trend there. And I think that's why the data that has come out in the past few sessions haven't been exactly encouraging. I mean, job openings did drop a little bit, but it's still historically elevated. And all eyes are now on payrolls this Friday and CPI next week.
Non-farm payrolls, as you say, on Friday, really, really central to how we form our views about the Fed. In terms of the market impact, yields coming off very modestly today, about 2-3 basis points at the front end, the 2-year still holding above that 5% level. The implications across these markets, and the markets adjusting well to this commentary from Fed Jay Powell, the shock factor around 50 basis points, if that's what happens come March the 22nd, how much volatility could that inject into these markets?
Yeah, I think it's probably helpful to note that markets have already repriced their expectations of the peak Fed funds rate this year earlier last month. But we did see a little bit more repricing recently because earlier markets were solidly expecting 25 basis points for this March meeting, but now it's like closer to 50. And so I think that, you know, it's still going to take some time to digest, and we could see more volatility.
Okay, more volatility potentially in the cards. Thank you very much indeed, Bloomberg's Justina Lee, of course, on the comments from Jay Powell there. Of course, giving his second day of testimony and softening the tone a little bit when it comes to the 50 basis point conversation and just how far they go. Of course, the market's now pricing at about 5.7% in terms of the terminal rate from the Federal Reserve. Let's get to a big corporate story, the corporate story of the moment, back in focus for us again today. Credit Suisse is trading lower this morning after the bank says there will be a delay in the publication of its 2022 annual report. This comes after the SEC raised a last-minute query on previous statements. Joining us now is Michael Moore, Bloomberg Finance Editor. Michael, let's start with a question around Credit Suisse. It's not every day that the SEC picks up the phone to you on a Wednesday evening and says, hang on, we want to check 2019, 2020 results, or at least cash flow statements. How serious potentially is this for Credit Suisse?
You know, it's a little hard to tell at the moment. It's odd to delay an annual report over these previous questions, whether that's, you know, the bank being rightfully cautious. You know, sometimes, often the U.S. banks don't set a specific date for their annual reports, so there may be situations where they have to wait a minute to and we don't know about it. But it certainly, it's not the best look for them given all the trouble they've had. It's a little unclear how serious this could be. Like I said, are they being cautious, or is this a major question given that it impacts 2019 and 2020 restatements and not the 2022 results? That may give investors some you know, comfort, but the stock is down, and it's one more thing that investors are having to grapple with.
So at this point, if they were to get just a month behind them of no bad news, that would be an achievement for Credit Suisse. So far, they're not able to do that. Down 3.7%, as you say, the stock on the back of that news. Meanwhile, this is a very, very serious story unfolding. Of course, the controversy, the scandal, the litigation involving JP Morgan suing its former executive, Jez Staley, for Epstein dealings. What do we know?
So JP Morgan has been sued by Jane Doe, an alleged victim, and by the U.S. Virgin Islands over its role in having Epstein as a client. JP Morgan has now turned and said, if there is any issue here, it's just Staley's issue, because he was the executive in charge of this relationship. It's certainly a dramatic move for JP Morgan to go from saying there's nothing here to blaming Staley. Staley has consistently denied any knowledge of Epstein's criminal dealings beyond what was publicly known. But it's certainly raises a lot of questions for Staley himself. It raises questions for Barclays, which, you know, he was running up until 18 months ago, and which there's still some outstanding awards and pay that Barclays may or may not have to pay to Staley. JP Morgan is going after Staley for the pay he made during his time there. So this is, a pretty dramatic development in what has been a long-running saga.
And looking to squeeze about 8 years of back pay from Staley as well, JP Morgan. A really, really important story that you and the team will be across for us. Thank you for the latest on that. JP Morgan, of course, and the lawsuit against Jez Staley, former CEO of Barclays and, of course, head of wealth, formerly at JP Morgan. Thank you, Michael Moore. Now, coming up, we are going to speak with former Croatian President Kolinda Grabar-Kitarović. It is the first of 2 exclusive interviews this hour, live from Bank of America's Global Investor Summit in Paris. And later in the show, we're going to sit down with Bank of America Chairman and CEO Brian Moynihan. Do not miss that interview. This is Bloomberg. Economics, finance, politics, of course. Stay with us.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, Bank of America is hosting its first Global Investor Summit in Paris as the French capital's finance profile rises. Let's cross over then to Bloomberg's Francine Lacroix, who is at the summit along with a guest. Francine.
Thank you so much, Tom. Yes, we're here at the Bank of America Global Summit, their first, actually, and we've been speaking to the Apollo chief executive. We've also been speaking to senior management at Bank of America, and now we want to focus a little bit on politics. So I am delighted to be joined by Kolinda Grabar-Kitarović, the former president of Croatia. Thank you so much, Madam President, for joining us here in Paris. A lot of the configuration in terms of peace in Europe depends on what happens in Ukraine. Some say this will be protracted. Some say, look, we could see a resolution sooner. How do you see this ending?
Well, it's impossible to predict what the ending will be, but we're in for a long haul, certainly. It depends on what will happen on the battlefield. We're currently at a relative stalemate where we have a grinding war of attrition, where Russia is slowly gaining a little bit of ground, but Ukrainians are putting up really strong defense. And both sides are looking for a breakthrough. Now, with the current situation, for Ukrainians to be able to make much progress, they would need really an increase, quite an increase in the quality and quantity of weapons. And for Russia, President Putin more or less announced in his State of the Union speech for the Russian audiences, for the Russian public to prepare for a long war. And that long war works in his favor because what he's doing right now is consolidating the defenses in the occupied areas and preparing for a new offensive. Of course, for Ukraine, it's of utmost importance to liberate and reintegrate the occupied territories. It's an issue of state sovereignty and territorial integrity. And respecting Ukraine's right to self-defense based on the UN Charter.
I mean, there's now talk from the Western allies of sending planes. Does that make a material difference on the battleground?
Well, right now, what would make a material difference is actually shifting that war from that grinding artillery attacks, where so much ammunitions are being spent, and Russia has turned to a war economy where basically 24/7 they produce missiles and shells to pound Ukrainian infrastructure, including energy and civilian infrastructure. And what Ukraine needs is ammunitions, it needs tanks, but also needs training to shift from that artillery warfare, to shift from what we currently have, a combination of World War I trench warfare and tank battles from World War II, to more sophisticated types of warfare where quality really dominates over the quantity.
I mean, is this the Russia war on Ukraine, or is this almost also proxy war between the West and the East to kind of, you know, to take two of, what's China's role in this then?
This isn't a proxy war, not at all. What NATO and the West, I don't like to actually call our countries the West.
How would you call them?
I would call them an alliance of liberal democracies who support Ukraine and Ukraine's right to self-defense and the principles of international law and order and the UN Charter, so state sovereignty, territorial integrity, and the right of every nation to choose their own future. Now, China, obviously, is becoming a global player, and they want to profile that position a lot further. They recently proposed that 12-point peace plan for Ukraine, which is not actually a peace plan. Even Minsk and Minsk II were a lot more detailed than that. It's more of a geopolitical statement where you see support for Russia, that is political, that is ideological.
And that will stay?
That I believe will stay, although Russia and China have had their historical grievances. But in today's world of geopolitical shifts, that alignment between Russia and China is important to Russia and China. It's important for China that Russia not be humiliated, but I think that what goes in favor of China is also the fact that Russia, with this war, has become a junior partner to China. They have literally descended from the Championships League to Juniors League with respect to China and the global position of Russia overall.
Is there any way of changing China's position in this? And if there is, would the war get de-escalated quite quickly? And who would be able to convince China to think otherwise?
The war could end right now if Russia stopped attacking Ukraine and pulled their forces out, because this is an aggression against Ukraine. The war is being fought on Ukrainian soil, and Ukraine is defending themselves. There are some positive aspects that China really supports the principles of state sovereignty and territorial integrity. And even Russia recognized Ukraine within internationally recognized borders, including Crimea. However, there are also some concerning factors, as stating that when considering one's security, one should consider other security as well, hinting at the fact that Ukraine or some nations shouldn't have that right to choose their own alliances and their future.
But, Madam President, I mean, the fact that Vladimir Putin would now say, actually, no, this was a mistake, I stop, is what, at 0%. What is the chance of China saying, look, Vladimir Putin, this is a mistake, you have to scale it down because we will no longer support you?
I don't think that they would ever say that publicly. I am sure that they are putting pressure on Russia to de-escalate in a certain way. I'm convinced that, first of all, with respect to nuclear rhetoric that we heard a lot about towards the end of last summer and the beginning of September, that China has put pressure on Russia in order for Russia not to talk about nuclear solutions, because the nuclear war cannot be won and should never be fought. I think that China actually has put pressure on Russia to protect more civilian populations and POWs. However, what is concerning is that continued economic support, which is feeding Russia's war machine, like buying oil, albeit at a discounted price, but standing by Russia in this quest and asking for a ceasefire without actually asking for Russia to pull out of Ukraine.
Do you think Ukraine should be part of NATO?
NATO's door remains open. It is up to NATO and for prospective countries to decide on their own future. The focus right now is on assisting Ukraine to defend themselves and to provide the proper resources, because in order to keep peace in Europe, we do need Ukraine to remain a sovereign and independent state.
You are one of the names as possible candidate to replace the Secretary General of NATO. Do you think NATO would be ready to be led by a woman?
Well, these are not the times to express any personal preferences. I think these are crucial times for collective interests of self-defense in Europe, and I believe that whoever becomes the future NATO Secretary General has to have at least three crucial capabilities. One is to be able to work across belligerent lines and divisions across aisles. The second one is to be able to deal with the post-war situation in Europe, where we will still have Russia's attempts at aggression and expansionism as challenges to European and global security. And the third crucial aspect is really to be able to deal with or to work with NATO allies and partners in order to de-escalate and diffuse tensions and situations of potential escalation wherever possible with Russia.
President Kitarovic, thank you so much for joining us. That was, of course, the former president of Croatia. Tom, with that, I'm going to send it back to you in London, and then coming up, we'll have plenty more from the conference. We also speak to the chief executive of Bank of America shortly.
Francine, thank you very much indeed. And of course, Francine Lacqua is at the Bank of America Global Investment Summit in Paris, and we'll bring you that exclusive interview, of course, with the CEO and chairman of Bank of America in the coming minutes. Coming up, tens of thousands protest across Israel over plans to cut the power of the Supreme Court. We bring you the latest from Tel Aviv next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Added the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, tens of thousands of people are protesting across Israel over plans to cut the power of the Supreme Court. The Israeli Defense Ministry says U.S. Defense Secretary Lloyd Austin has moved his bilateral meeting to the airport in Tel Aviv due to those disruptions. Let's bring in Bloomberg's senior editor in Tel Aviv, Ethan Bronner. Ethan, just get us up to speed on what is happening on the ground and but the potential impact for markets.
Well, potential impact for markets is being felt, I think. Basically, we've had for 9 or almost 10 weeks in a row an extraordinary number of Israelis out on the streets, sometimes hundreds of thousands. Today, it's the beginning of the day here, but we've got tens of thousands in about 20 different places, including at the airport, where the Prime Minister is hoping to go to Rome. So basically, the problem is that people are afraid that if the court's power, the Supreme Court's power, is reduced, that will, in fact, turn the legislature and the executive able to do whatever it wants, and the checks and balances needed for a proper democratic country will fall away, and that the kinds of investments that have really driven this country to incredible wealth over the last 10 or 15 years will disappear. There is already talk of several billion dollars, perhaps, that may or may not be leaving or have not coming. And so, in addition to that, we have military reservists saying that they don't want to serve if this change goes through. The military reservists typically are also the people who run the business in this country. They've often, the high-tech in this country has been extraordinary, and they got their start in the high-tech part of the military. So it's all rather linked, and it's something of a culture war between popular, religious part of the country and the more secular, well-off part of the country.
Okay, Ethan Bronner in Tel Aviv on a really important story, the implications for the democracy of Israel and, of course, investors with exposure to that economy. Let's briefly check in on what's happening with Credit Suisse in particular. That stock down now by 4.6% after it delays its annual report after a query by the Securities Exchange Commission. Down 4.6%. Dassault Aviation, though, storming up 10% on the back of better earnings. Come up, we're going to speak to the CEO of Bank of America. Stay with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Next week, Balance of Power is on the move. Starting Monday, March 13th, Balance of Power debuts at 5 p.m. Eastern Time, live from Bloomberg's Washington headquarters. Hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis at the intersection of politics and business. Balance of Power, weekdays at 5 p.m. Eastern, starting Monday. Only on Bloomberg, your global business authority.
Good morning and welcome to Bloomberg UK. I'm Tom McKenzie in London. On the show this week, Paris in the spotlight after Brexit, our exclusive interview with the Bank of America Chairman and CEO Brian Moynihan, live from the Lenders Global Investor Summit in the French capital. Also on the programme, flickers of life appear to be returning to the UK housing market. We'll discuss the latest survey from the Royal Institution of Chartered Surveyors. Plus, our interview with dovish policymaker at the Bank of England, Swati Dhingra, who says more rate rises could damage a weak UK economy. Let's return then to a story we've been covering this morning. Bank of America is hosting its first Global Investor Summit in Paris. The French capital's finance sector has seen huge growth in recent years following the UK's exit from the European Union. Let's get to Bloomberg's Francine Lacqua, who is at the summit along with a guest. Francine.
Tom, thank you so much. We've had some great guests so far. We spoke to the Apollo Chief Executive Officer. We spoke about NATO and Ukraine with the former Croatian president. And now we're joined really by our host today. He's Brian Moynihan, and he's the Chief Executive Officer of Bank of America. Brian, first of all, thank you so much. You're putting on a great conference. And you're here in Paris because you were really one of the first Wall Street banks to say, look, in this Brexit world, this post-Brexit world, I want to choose Paris. Is this being vindicated?
I'm not sure what vindication would be. So post-Brexit, we looked around, and this was a place that we put our broker-dealer, our securities operations for Europe, and we've gone up 10 times the number of people we had in 2019, and that's a relatively short time frame. And we're very happy here. It works well. Vanessa Holtz and the team run it under Bernie Menz's leadership, and they do a great job. And more importantly, thank you for joining us today. It's a great conference, and we're glad to have you here to help us spread the word and get the ideas that come out of it out to the market.
So in this post-Brexit world, how do you see actually servicing your clients in Europe, and how do you see the animosity that maybe the two sides are getting closer in these Brexit negotiations?
Well, the Brexit negotiations are going to have a lot more to do than financial services, but our strategy from the beginning was to get operational, get our clients used to the fact that they're going to, what they call face off in the markets against different entities, get those entities stood up and put together. So we have a UK broker-dealer, and our bank is branched in the UK, and then we have our Ireland subsidiary and the French subsidiary, a bank and a broker-dealer. So you had to get ready to go. And so it'll work out over time, and we've been around for 200 plus years, so whatever rules, as long as they settle in, we can operate. But it was disruptive at the time, and it's going to have implications to how capital raising works in a market that wasn't completely unified yet. Even the promise of the Europe to get to combined capital markets and uniform capital markets was still in front of us, and now you split two major pieces. So we feel good about what we've done. It would have been easier if we didn't have to do it, but that's not our choice, and now we continue to adjust.
Brian, how many times a day do you get asked about U.S. inflation and the Fed?
Probably more than we should, because the U.S. has this big, huge economy which goes and moves along. And so, if you think about our team at Bank of America's research team, which is one of the best in the world, if not the best in the world, under Candace Browning-Platt and her leadership team, they basically have a recession predicted beginning of the third quarter this year, third, fourth, and first quarter, but it's a slight recession. It goes down 1% or 2% and then moves back up, and then gets back to 1.5% growth in the latter part of next year, but still below trend growth. And so the Fed has to cut off the inflation, and they're clear about that. And you had Chair Powell testify for 2 days, so I'm not going to illuminate anything.
And the markets were all over the place on the back of that.
It will be, because they're all trying to figure out. But remember, the big move was 0 to where we are now. We have 75 basis points more to 5.25, 5.5, but the big move is where we are now, and that is still soaking through the economy. So the most interest rate sensitive pieces of the economy impacted quickly. Housing, mortgage originations for banks down, other types of financing down. The capital markets adjusting caused the leverage finance and capital markets to close, and now they're opening back up, and that's good, but you're getting some stability. But that's the intended outcome: sucking liquidity out of the system, bank deposits going down, especially after the massive stimulus. That's what they're intending to do, and it's happening. Now the question is, how long do you have to wait against a good consumer and employment and things like that?
But are you surprised at how resilient the U.S. economy was? And I remember, 7-8 months ago, a lot of the chief executives, also of Wall Street banks, saying, look, there's going to be a tornado. It's going to be a really tough economy for the consumer. And actually, we have not seen them. Were they wrong, or is it just going to be delayed?
Well, it's going to be delayed. It has been delayed, so that's a fact. But the question is, if you look at the American consumer in February, so we track all the consumers and how they spend money, and that's $4 trillion plus a year. So it's not a small sample. And if you look at what happened in February, it increased over January's rate of year-over-year growth. It's now, for year to date, it's up to about 8.5%. February is higher than that, or up to 8%. February is about 8.5 to 9%. That means the consumer's accelerating again. And so the first thing is the consumer spending across all dimensions. Now, they've moved to services away from goods. The travel experiences, luxury hotel bookings are up a little bit more than regular hotel bookings. You can see all the activities. If you go to the other side of the track, do they have money in their accounts? If you look, high-end consumers, businesses move their money into the direct holding of securities, the wealth management customers, because that's what they do. But if you look at the mass, the general consumers we have, their account balances are still elevated multiples where they were pre-pandemic. And the spending them down, which is a big word, they're going down. In fact, in February, they rose a little over January. There's always some seasonality.
So you're confident. Actually, that numbers you're looking at
they're in
are
good
strong.
shape. Yeah, they're in good shape. Now, that makes the Fed's job tougher, and that's the dialogue you have about how you can slow it down. But it all comes back to unemployment. Unemployment's low. Wage increases are still pretty strong. And you don't see that. New claims for unemployment, we'll see what happens this week. But, each week it's hovering at a level. It's very low, and there's some seasonality debate, but it's still very low if you thought you were really in a recessionary environment.
And what's the market reaction function been like?
Well, it's been, when rates went up, obviously the adjustment and the marks, and last year was not a good year for equities or fixed income, which is very unusual. But if you think about it, the markets then have settled in, and you start to see a little bit of life in the capital markets. The pipelines are full. You saw some deals get through, and that's good news. And yet it's still not close to where it was when it was due, when it was in like 21 and early 22. But on the other hand, it's stabilizing. And so, yes, there's trading volatility every day, and yes, everything moves around. But the reality is a long-term thing is settling into place that says the Fed's, it has to move rates up and has to keep them there longer. That's the piece I think Chair Powell's been trying to make people hear over the last 6 months. We're going to have to hold them there longer to ensure that we've done the job, even if they don't go as high as people think or a little bit higher than people think. They got to hold them there longer.
Because do markets understand that? And actually, if you see yield back in fixed income, how does that change the whole asset class?
What's interesting, our economists have a rate decrease in March of next year, 24. Interesting enough, people forget that in 19 the Fed cut rates. This Fed cut rates when the economy was slowing down. So the question of when they come down the other side is interesting. But our economists, who are a very talented group, believe that they cut rates because they basically will have won the war on inflation, and then they'll bring it down. Because it's an inverted rate curve is not the normal experience, and they want to get to a real rate curve, but not necessarily an inverted one.
You're one of the only Wall Street banks not cutting jobs. Why?
Well, we have a phrase that we've used for many, many years, let attrition be our friend. And so with a 200,000 plus people, you have a normal turnover rate. It's starting to go down to an all-time low again. So we're running about 12% across the whole base. Going in the pandemic, dropped to 6%, worked its way back up, and now it's back down in the mid-single digit, which is terrific. A great place for teammates to work, doing a great job. the reality is you can manage that head count. And so we'll redeploy people across the franchise, including investment bankers to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
What do you spend most of your time on? Is it a strategy in China? Is it, I don't know if it's fintech or chat GPT?
Well, I spend all my time asking questions about all that because, I've got these talented teammates that drive the company. So, all the issues at the moment, how ChatGPT will affect. We have this thing called Erica, which is a virtual artificial intelligence, virtual assistant, natural language processing, predictive technology that we've been running for 4 or 5 years, and 18 million customers use it. 145, 150 million times a quarter. So we're used to it, but this is now a new one that could change the game, and so we're trying to.
Do you think it will? I mean, at the moment, you're not allowing it, are you?
Well,
are you using ChatGPT?
We aren't allowing it. That's more of a technical sort of security question and how it works and things. The use of artificial intelligence and predictive technologies we use not only on the consumer side, but we use that same technology internally. So, but it runs on our data in an environment we can understand. It doesn't have the exfiltration problem and stuff like that. So it's a great thing. That'll all work out over time. There'll be licenses and brought internal and work on your own data and then bring data into your things. And that's just working through the security things. That's the issue of letting a bunch of teammates go out in the public environment, start potentially pulling our data into the public environment without them understanding it.
All right, but so it will morph into some form that you'll be using basically internal in some way.
Some form of these. We already use it. That's what I'm saying. Artificial intelligence, we went to Stanford to say, give us a natural language processor for financial services. We built the artificial intelligence, worked on the data. We have the insights from the customers. You think about it. You could be driving down a road in a car at 60 miles an hour and talk to our mobile app, and it could go to 110 systems and find a specific transaction and tell you what it was. That's pretty amazing, but it takes the technology, the pipes to distribute the data array and accurate, and it's pretty wild. But that's still out in front of us.
Also sounds pretty stressful if you're on the wrong side of the trade. Talk to me about China. What's your reopening strategy, or what's your strategy in China given the reopening?
Well, across the world, we basically do two businesses: corporate investment banking, large companies, and capital markets. And Hong Kong is a major place for us, and we have in China itself. And we're continuing to support the companies that both multinationals doing business in China and very large Chinese companies. That's the business strategy we have. We haven't changed that. The atmosphere around it is obviously completely different than what it had been 5 years ago, but and that's something you deal with in the ebbs and flows of the world. But right now, it's just keep your risk where you want it, keep your operations in good shape, and make sure you understand what's going on.
But how do you look at the regulatory questions, or actually what China wants to do with financial services?
There's a lot of negotiations that are going to go on between our two countries over time here. And just like Brexit, when a set of rules become understood, we can do it. Right now, there's a set of rules that we operate within, and it's fine. But you wish it wasn't as difficult in some of these countries because of the geopolitics, but that's the reality of being in a business which basically works to reflect the economies of the countries around the world and helps clients prosper in them, and that's the nature of it. So we're there, but on the other hand, it's a little trickier being there than it was 5 or 6 years ago just because of the environment.
What are you most hopeful about in the next 12 months? I mean, we talked about the Inflation Reduction Act. I mean, there's so much actually going on news-wise. What do you see as a positive?
I think what I'm hopeful about is when you see all these companies that we work with, whether it's Sustainable Markets Initiative under King Charles' leadership, or whether it's the work we do at the World Economic Forum, or whether it's the work we do in the Business Roundtable in the U.S., or you see all these companies who understand fully that they've got to deliver for society and deliver for the shareholder in driving the changes, whether it's on the environment or other issues, and doing it from a fundamentalistic capitalistic basis, that the capital can be redeployed. And charity doesn't earn a return. I mean, it's psychographic and impact, but the reality is, once you give away the money,
this is real
capitalism has to solve it. And so we did, in the sustainable finance area generally, we've done $430 billion in a couple of years. Our 10-year program for $1.5 trillion. We're averaging 200+ billion a year. Environments, 230 of that. And our customers are making the change. Each day I get up and I get a feed of stories and stuff all about all the deals that went on in the environment space. It's amazing what's going on, driven by the private sector. And that's what gives me huge confidence, not only the next 12 months beyond, is the private sector is leading this, which means it has stick to the ribs quality.
Brian Moynihan, thank you so much for joining us today. And thank you again for a conference. We'll have plenty more, of course, from the conference. We also have a former French president coming up, Tom, so we'll bring you that interview shortly. And this is Bloomberg.
Okay, Bloomberg's Francine Lacroix, of course, at the Bank of America Global Investor Summit in Paris. Now, still ahead from that summit, an exclusive interview with the former US House of Representatives Speaker Paul Ryan. That's at 10:30 a.m. London time, 5:30 a.m. if you're in New York. Coming up, UK property surveyors say flickers of life are returning to the UK housing market. We get the details. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Tom McKenzie in London. Now, the UK property surveyors say there are now flickers of life in the housing market as both buyers and sellers return to the market in February. The Royal Institution of Chartered Surveyors, RICS, says prices fell again, but its more forward-looking survey pointed to signs of improvement. Let's bring in Tarrant Parsons then, senior economist at the Royal Institution of Chartered Surveyors. Tarrant, thank you, and good morning. Thank you for joining us this morning. Where is the relative resilience then in an environment, of course, of houses and households under pressure, the cost of living crisis, higher mortgage rates, but there seems to be, and this is what the survey points out, relative resilience within the UK housing market. What are the supporting factors?
Yeah, I would kind of caveat that with saying trends across the UK housing market are still quite downbeat in terms of the overall picture being reported for activity. But just last month we saw our indicators on buyer demand and sales volumes, albeit they're still weak. They did move off of the lows that were seen right at the end of the last year. What I think has happened is we saw a very sharp adjustment following the spike in mortgage rates in October. Financial markets have settled somewhat since then, and mortgage rates have come back slightly. They're still much higher than 12 months ago, but the real drop off in activity came at the end of last year. Still weak now, but recovering maybe slightly.
So where does that leave the RICS view on house prices if you look out a further 6 to 12 months? How much more downside is there across the pricing of housing?
Well, looking at our data and its kind of track record for leading upcoming changes in the official house price index, I think a reasonable projection at this stage would be to say that prices could be down by somewhere in the region of 10% year on year. That's at the national level in 6 months' time. I think the fact that our price indicator didn't really sink any deeper into negative territory this month may even suggest that the decline might not be quite as steep as that. But then again, I think the situation is very fluid. It's very difficult to give a precise forecast when there's so much uncertainty around the outlook for the economy and for interest rates. So that 10% fall seems a sensible estimate at this stage for me.
Okay, 10% year on year as the fall for house prices. Before we let you go, Tarrant, a view then from what to expect from the budget. It is, of course, next week, March the 15th. What do you and the team at RICS want to see from this government to support the housing sector?
Any support for kind of house building or retrofitting is always going to be welcome. I know house prices are falling right now, but there is a real, that's because of the mortgage rate increase. There's a real kind of supply shortfall, especially if you look at the rental market. So tenant demand is still very strong. That's pushing rents higher, and both home ownership is very costly. Rental prices are very costly as well and rising sharply still. So delivering more units is going to be critical if you really want to make the UK housing market more accessible longer term.
Okay, Tarrant Parsons, Senior Economist at the Royal Institution of Chartered Surveyors. RICS, thank you very much indeed in what is needed from that budget that, of course, is coming up next week and the state of the UK housing market. Now, coming up, the BOE, the Bank of England in the balance. We dissect some of the diverging views, and they are diverging, from the rate setting committee this week. That is next. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
Okay, the Bank of England's Catherine Mann there speaking to Francine earlier this week about the need for tighter monetary policy. After these hawkish comments, the BOE's more dovish MPC member, Swati Dhingra, has warned against further interest rate rises, saying it could damage a weak UK economy. Our UK correspondent Lizzie Burden joins us now and has been speaking to Swati Dhingra. What did she have to say on this panel? Arguably one of the most interesting members of the MPC at this point.
Indeed, Tom, and we've got you covered here on Bloomberg. We've got the Hawks and the Doves. Swati Dhingra came out with her first speech since joining the Monetary Policy Committee yesterday. As you know, she's already voted to hold rates twice. She suggested that she would do the same again at the meeting coming up this month. And the reason is, she says that over-tightening risks denting the economy. The difference between her and Catherine Mann is she says the Hawks are too focused on domestically driven inflation. Take a listen to this.
Wage inflation is really a measure of the distribution of the losses from trade. It is not a measure of average losses from trade. And as a Monetary Policy Committee member, it is not our job to be able to take any kind of judgment on how the losses should be divided across the population.
So look, Swati Dhingra is the trade expert of the committee. What she says is that most of our inflation is actually imported, and she also emphasises the lag in monetary transmission. So she says the previous jumbo hikes have still yet to fully take hold, and that chimes with some of even the Hawks, formerly of the committee, who we've been speaking to. So Michael Saunders told us on Bloomberg Radio that even he would ease the pace of hikes to 25 basis points, and Andy Haldane, the former chief economist, says that he would move cautiously from here.
So the dividing lines are quite clear, though, between the Hawks and the Doves. How does that set us up for the meeting? It's 2 weeks away.
Yeah, well, it's interesting that you've had the ECB and the Fed making some hawkish noises. You saw at one point yesterday traders pricing for a peak of 5% in the key rate for the Bank of England. I put this to Swati Dhingra because it's interesting, isn't it, that the UK sits in the middle of the Venn diagram between the US's tight labour market and Europe's energy crisis. You would think, perhaps, that the UK should double down and be even more hawkish. Well, her argument is that there are differences even between France and Germany. The US is more consumer-driven, and actually, she's not as worried about a further drop in the pound as Catherine Mann told us she was. Take a listen.
So how worried as a first order should I be about the exchange rate? I think not as much as I should be about some of the other factors.
And the reason for Dhingra is because when she looks at the imports, most of them are not priced in dollars. So this goes some way to explaining how you can have such a split on the committee, members looking at the same data but reaching different conclusions. And what it means for the next meeting is it's going to come down to the men, because they're sandwiched between the external female members at the different ends of the spectrum.
Well, that's a shame, isn't it? We hope we moved on for that. But the debate is real. It's significant, of course, for the UK economy. Thank you very much indeed, Lizzie Burden. The pound, of course, maybe arguably from Swati Dhingra's perspective, a softer pound isn't that terrible when it comes to the inflation picture. Credit Suisse tumbling 5% as they withhold their annual report on the SEC questions. Stay with us. This is Bloomberg.
so now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stock, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
The top names in business are on Bloomberg.
AI is real. We're already using it to do risk, fraud, marketing, prospecting, and it's the tip of the iceberg. This is extraordinary. And the other thing to keep in mind, there's good use, but bad guys are going to use it too. So it's a little bit of an arms race in how you have to use it to protect your company, protect your clients, protect data, et cetera. And we're fully engaged.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
It sure looks like the economy is resilient and they're going to have to raise certainly more than is priced in.
We've seen some progress, but at 5.5%, inflation remains well above the Fed's 2% target. And as a result, we've made clear we still have work to do.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Bank of America CEO Brian Moynihan speaking exclusively with Bloomberg moments ago at his firm's Global Investor Summit in Paris. This hour, we will hear from former House Speaker Paul Ryan and Bernard Mensah, President of International for Bank of America. Credit Suisse puts its annual report on hold. U.S. regulators have some last-minute questions about previous statements. And President Biden wants to impose a 25% minimum tax on billionaires. In his budget request, the president also calls for a big jump in capital gains taxes. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And a lot happening in Paris, it seems. Kriti will bring more comments from the CEO of Bank of America a little bit later on. So that's one thing we're following. Really, it's all about yields and stocks, the way the two relate to each other. And certainly stocks not taking any comfort from what we've heard over 2 days then from the Fed chair.
Certainly risk sentiment kind of driving lower. And what's interesting here is, look, we're still waiting for that jobs report that's coming in tomorrow. That's going to be the major game changer for traders. So there isn't necessarily this massive conviction, this massive bid to go into the markets right now. And you see that across the board. Futures, for example, are lower. And you can see that by about 0.4%. This is important because we want to really see that sustainable hopping into the market. The question is, what is the market prepared for tomorrow? If we get a hot labor report, is that simply a kind of a positioning story? Or if we get get a dovish labor report, do we then call that kind of one data point in a longer trend? Regardless, I think you're going to see a bigger reaction in the bond market than the stock market, because that's really where all the repricing is happening. 3.98 on the 10-year yield, just shy of that 4% level. Now, unchanged on the day, but really watch for that intraday volatility, because it's all about, again, that keyword positioning going into tomorrow's labor report. And by the way, the CPI report next week as well. NYMEX crude is a big story, 76 handle there. Inflation is a major theme still. Even though it's coming down in the United States, coming down in Europe, it's not necessarily coming down everywhere as fast as it is in the West. And that's going to be a big part of what's driving the dollar here, weaker on the day by about 0.2%. A lot of that inflation story, though, coming not from the U.S., not from Europe, but from Asia. Overnight, seeing a little bit of mixed sentiment. The MSCI Asia Pacific Index as a net, all in all, kind of unchanged on the day. But look under the hood, and that's where you see the real divergence. The Hang Seng, for example, down about 0.6%. And this is really important because you got Chinese inflation data overnight. They said, look, inflation is coming down, but it's not coming down as fast as, again, it's coming down here in the United States and arguably in Europe as well, even though even that is starting to prove a little bit sticky. On the other hand, you have Japan really outperforming. The Nikkei stronger by about 0.6%. And in fact, the Japanese story is what's driving the dollar lower, because if you look at what's contributing to the dollar weakness today, Anna, it's all about the yen. And as you see dollar yen trading at about 136.20, stronger for the yen by about 0.8%.
Yeah, quite a substantial move there in dollar yen. And of course, the BOJ starts its last meeting today, or has held its last meeting today under Haruhiko Kuroda. That continues tomorrow, that meeting. We get the results of that overnight US time. This is the picture for European stocks then. European equity markets trading weaker. Most sectors in Europe are in negative territory. The insurance sector, one area of brightness, but elsewhere we are seeing moves a little bit lower. Is it about the higher yield environment? We're seeing European yields ticking up once again, not at year-to-date highs perhaps, but still ticking up back towards those. And so I pulled out a German contract just to show you what we're seeing, but I could have pulled out the Italian, the French, the UK trend, all of those looking fairly similar. Here we've got the UK yield, in fact, moving a little bit higher. This is Dassault Aviation. This is up by 10.3%, one of the best performers on the Stock 600 this morning. And in fact, the full year profits coming in better than expected, and that's helping to cushion the stock, given that the CEO is still talking about supply chain issues for this defense business, but that not the key driver today, it would seem. Aviva, this is the strength in the insurance sector I was talking about. So a big player in the UK insurance market. That stock is up by 2.6%. They're returning cash to shareholders. The numbers came in the right side of investor expectation. A wide-ranging conversation with Amanda Blanc, the CEO of Aviva, if you want to look that up on the Bloomberg terminal earlier on this morning. And Deutsche Post is up by 1.2%. This is a logistics business, of course, Chrissy, and during 2020, as freight rates soared, we saw them having an incredibly strong performance, turning in a strong performance. Now things looking more normal, normalizing a little bit, but they are returning more cash to shareholders, so it's managing to turn around early underperformance of the stock to see it up by just over 1%.
You use that keyword normalizing for the consumer, normalizing for the Federal Reserve. It all comes down to how do you actually navigate it from an investor standpoint, which brings us to Bank of America hosting its very first Global Investor Summit in Paris as the French capital's finance profile rises. CEO Brian Moynihan spoke exclusively with Bloomberg in the last hour about the American economy.
The U.S. has this big, huge economy which goes and moves along. And so, if you think about, our team at Bank of America's research team, which is one of the best in the world, if not the best in the world, under Candace Browning-Platt and our leadership team, they basically have a recession predicted beginning in the third quarter this year, third, fourth, and first quarter. But it's a slight recession. It goes down 1% or 2% and then moves back up. And then gets back to 1.5% growth in the latter part of next year, but still below trend growth.
Sonali Basak, our global finance correspondent, joins us now for some of the key takeaways. Sonali, he just said there, Bank of America forecasting a slight recession in perhaps this year, the back half this year, early 2024. Walk us through what else stood out to you.
Yeah, he's been pretty sanguine about the economic forecast. And if you look at it now, a lot of his rivals are also joining him. For example, David Solomon this week has also said that he's not as negative on the economy as maybe he probably was before. He sees the possibility of a soft landing. Citigroup's Mark Mason also saying mild recession. But here's the thing, Critty, it's really a question about rates and inflation still. This uncertainty around interest rates, I would say Brian Moynihan today had kind of mentioned this idea of a delay of what it means for the consumer. And that delay is the big unknown for the big consumer banks. Similarly, JP Morgan earlier this week talked about a cliff in the consumer at the end of the year. And with Bank of America, the good news is that he says that a lot of the rate rises we've seen kind of the worst impacts of it, if you will. I would say that is a little bit of a different tone than his rivals. When I asked Mark Mason of Citigroup yesterday what he was concerned about, it is still the trajectory of rates and the uncertainty about the central banking path in the United States.
Yeah, and Sonali, let's stick on that. Let's go from Bank of America to Citigroup, because the CFO, Mark Mason, says his firm will adjust headcount in its investment banking division as necessary as it continues to look for ways to boost profits. And I know he spoke exclusively to you, to Sonali, just yesterday. Let's take a listen.
We've been doing lots of hiring over the past couple of years. We've really been trying to build out in areas where we've had either a competitive advantage or an area we think suggests significant growth opportunities. So we've been investing in investment banking.
So, Sonali, what stood out to you in your conversation there with Citi?
A few things, because we know that Citigroup has already cut a couple hundred people when it comes to their investment bank. And listen, Anna, this year is not shaping up like everyone thought it would. We also spoke to one of the top investment bankers at RBC yesterday, and caution is what he kept on talking about. And again, it boils down to the trajectory of rates. People thought that they would start to stabilize in the middle of this year, and guess what? They have not. And therefore, you're seeing investment banking activity be much more muted than many bankers were hoping for. I would also point to what Bank of America had said today to Francine, what Brian Moynihan had said, which is that attrition is our friend. And so you're seeing the banks pull every lever they can, because what they want to be trying to do is keep the bankers through the cycle so that they can come out on the other end very strongly. But again, this year is not shaping up to be so far what many people had hoped.
Okay, Sonali, thank you very much. Bloomberg's Sonali Basak with us to talk about some of those latest themes coming out of US banks. Let's get back to the European banking space. Credit Suisse has delayed publication of its annual report after last-minute questions from US regulators. The Swiss bank was due to publish the report today, but the SEC had questions about revisions Credit Suisse made to previous cash flow statements. Let's get any detail that we can get on this story with our Bloomberg finance reporter Tom Metcalf, who joins me on set here in London. Tom, good morning to you. So Credit Suisse delaying the release of its annual report. That's got to be pretty unusual. Do we know much about why?
Yeah, it's very rare for an annual report to be delayed. Look, from the reading of the statement, it does seem like more of a technicality. So basically, the SEC, very last minute, came in and said, hey, what about these cash flows in 2019, 2020? Credit Suisse have come out and said, look, our financials for 2022, they're not going to change. We just need to sort this through, dot the I's, cross the T's with the regulator. But look, anything involving accountancy and questions around that, shareholders just do not like. So I think the shares are down 2-3% today. And, you know, in the whole context of Credit Suisse, it's just another sort of unfortunate moment where, you know, they just can't seem to catch a break.
Yeah, in fact, down a little more than that now, down just over 5%. Chrissy?
Yeah, Tom, put this into some perspective for us. How unusual is it to see such an intervention from the SEC, not just on an American bank or a bank in general, but one that isn't American?
Yeah, I mean, there's definitely, these interventions do happen. What I think is rare here is it causes something like an annual report to be delayed. So Credit Suisse have already come out and discussed their full year Q4 results. But what, you know, this report is about is putting that all together, all the disclosures. And it looks like, you know, in 2019, 2020, there's very complicated restructuring in terms of the accountancy behind it. Looks like it's sort of flagged some alarm bells at the SEC.
Certainly something that is, as you said, means that Credit Suisse just can't catch a break. Bloomberg's Tom Metcalf, thank you as always for walking us through that story. I want to go from the Zurich/Washington to the politics of Washington. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax, and income taxes on corporations and wealthy Americans would be raised. And the current Bloomberg economics reporter is keeping his eye on Washington for us. And these tax measures, how likely is it that they actually come through fruition?
Well, they're very unlikely given the Republican control of Congress. But like you mentioned, this is all about Biden's economic and political agenda. He's trying to roll back some of the breaks during the Trump administration years. You mentioned there almost a doubling of capital gains tax in the proposals. There's also that big tax hike on billionaires and the richest in the US. Of course, that's all fitting into the broader Biden narrative. He has tried to get measures like this through before, but of course he hasn't had the votes in the past. What it does also speak to, though, is a little bit about the deficit debate that will, of course, be coming up later this year with the threat of the debt ceiling and the government shutdown and everything else. So this one speaks to both the economics of the Biden administration and, of course, the politics that will be staring down the line when those debates hot up on the debt ceiling later this year.
Yeah, give us a bit more then, Enda, on how this fits into that broader picture. How do these tax measures fit into Biden's economic agenda?
Well, of course, on paper, it's all about wealth redistribution. It's all about tackling inequality. It's a way of targeting the deficit. As I said to you before, the Build It Back Better campaign was a big part of the Biden administration's push, but, you know, they had to make a lot of compromise on that too. So it fits into Biden's broader outlook. And of course, chatter of US election campaign will get off the ground again as this year gets going. But as I say, the reality of this dictates that the Republicans won't allow it to go through. The Speaker of the House, Kevin McCarthy, has already been out raising questions about it. So it's more a case of flag waving by the Biden administration rather than achieving anything substantial. But it does speak to where we will be in a few months from now, which will be a big clash on the debt ceiling and the deficit story in the US.
Certainly comments that are perhaps adding to the lower risk sentiment we're seeing in markets today. Bloomberg's End of Current, we thank you as always for walking. Silvergate can't either. It's already down about 44% in the pre-market. Perhaps not as bad as it was earlier. It was down at 50% at one point. Now, perhaps pairing some of those losses, but still 44% lower on the day, Anna. Nothing to scoff at there. I want to stick with the banking story and go to Silicon Valley Bank, or otherwise known as SVP, falling on a $1.25 billion share offering. They're announcing that $21 billion security sale, essentially it having a dilutive effect on the shares specifically. So you can see those shares down about 27% in the pre-market, which brings us then to one story that is not at all related to banking, crypto, or technology. Etsy is the one catching my eye, this time prompted by an analyst downgrade, cut to an underperform over at Jefferies, a price target of $85 a share, really trading at 107 right now, nevertheless pushing those shares down lower by about 5%, Anna.
Chrissy, we'll focus on those in the pre-market, but also coming up on the program then, more from the Bank of America Global Investor Summit in Paris. We already heard from the CEO of Bank of America. We will be back in Paris shortly. We'll be speaking with the former House Speaker, Paul Ryan, and Bernard Menser, President of International for Bank of America. And a non-recession recession. Apollo CEO Mark Rowan thinks the current distress cycle might not be that bad.
The excesses in 2007 were funded with leverage. The excesses in 2021 were funded with equity. So I believe that while we will have some amount of distress, I don't think the distress cycle will be anything like what we saw in 2008. And I think most of the pain is actually going to be borne by equity.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 point. Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America. Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, Friday on Bloomberg Television and Radio.
We're still very bullish on India, and there's so many companies out there that have excellent corporate governance. So I have no worry about Adani and how it's affecting the Indian market.
Mark Mobius and Mobius Capital Partners speaking with Bloomberg earlier saying, look, he is still bullish on India. Joining us now with a little bit more perspective, Sergey Durgachev, Union Investment Senior Portfolio Manager and Head of EM Corporate Debt. A pleasure to have you on the show. Sergey, let's start there. We're seeing kind of this dollar weakness story pick up in the markets. It was supposed to make EM the no-brainer trade. To what extent has the saga with Gautam Adani's big, massive company and enterprises, his empire, really cast a shadow on that trade?
Yeah, thank you very much, Kuti. First of all, the situation of Adani, we view it as an idiosyncratic event. Union Investment has not been engaged in Adani. Actually, we are not engaged in this name since early last year. And we think that this situation casts actually the importance of getting more thorough analysis of ESG risks, which are becoming actually more prominent also in assessing the creditworthiness of emerging markets corporates and emerging market sovereigns.
Well, when we're looking at the emerging market story, it does feel like it's been really at the whim of the dollar. But as we look at a Federal Reserve that is perhaps still looking to be even more hawkish, higher for longer seems to be the consensus here stateside, does that then make EM suddenly far less attractive than it was, say, 6 weeks ago?
No, because on one hand side, we have seen a superb start of the year. I mean, the total return was for EM hard currency sovereigns about 5%, for emerging markets corporates about 3%. Now we actually about 0.6 and about 1.4% respectively. And to a large degree, this has been actually erased by actually the expectations that we had basically from November last year from the market, that actually the inflation path will be actually gradually reduced. And actually we've seen also in the markets that due to psychologically driven also attention of investors towards each individual data print, that some small deviations basically can cause huge swings in volatility. And actually regarding emerging markets hard currency, but also to local currency in some ways as well, we are still, I would say in quotation marks, also like hostage to the situation regarding developed market growth and central bank policy, because this is the primary performance driver so far at the moment for emerging market assets.
Sergey, can I ask you, we started the conversation talking about India there. Chrissy was asking you about that. How do you make sure then that you stay on the right side of trades with the opportunities that the sort of economic rise of India represents during the COVID boom, given during the COVID period, given the way that China treated COVID, given the geopolitical tensions between China and the West, this was seen as a period where India would benefit. How do you make sure you pick the right opportunities in a place like India, given what we've seen with Adani?
Yeah, we like India, and I'm speaking more about the hard currency, especially corporate and banking debt side, because one of the advantages of India, actually there are two aspects. One is the supply out of Indian corporate and banking space has been actually very low. We haven't seen that many deals last year, and even this year we have only the HDFC with 3-year dollar bond coming to the market. So the pipeline is very thin, which is a positive technical. And the second aspect is many things have changed for emerging markets since Russia-Ukraine war started last year. And because some countries have actually also benefited as a gateway between East and the West in this new geopolitical transformation, and India is certainly one of the beneficiaries, being very crucial geopolitically, both to the West, but also to Russia and China.
Yeah, interesting role that India plays there. You mentioned issuance there in the context of the India story. What about the broader issuance picture when it comes to emerging markets? I know that you've told us that you're seeing actually quite slow new issuance pipeline in sovereigns and in corporates, perhaps. What kind of a clue is that for investors?
Basically, we see it as a positive signal, and I can explain why. Because for sovereigns, we have around about $70 billion issued that year, but a lot is actually basically those backlog coming from difficult 2022. So basically, we cannot claim that it's a very huge amount of issuance. For corporates, it's even less so. So we are about $62 billion of emerging markets corporate issuance. The positive thing is we are realizing that in this current environment, not every issuer can actually issue debt. So many issuers who actually used the slow interest rate environment in 2017, 2018, like for example, many companies from China, in particular Chinese high-yield companies, they are at the moment, they cannot actually, or at very high prices can actually access the market. So we expect that the issuance picture will be actually, that we will see not a huge supply, so there will be more selective issuance. And what we are also observing that some new countries are actually getting more traction, that we'll see potentially also more deals from issuers from newer countries, like for example, Saudi Arabia, which is a good example where issuance is picking up also on the corporate debt side, where the country and also the capital markets are opening up.
Well, Sergey, you mentioned the corporate debt side on the EM space, but talk to us a little bit about simply the kind of regions where you're starting to see a lot more attractive opportunities, specifically on the corporates that are issuing.
Yeah, we are very confident on one hand side on the GCC, especially on Qatar and also on UAE-based issuers, because both countries, they benefited a lot from this geopolitical transformation. They are benefiting also from energy transformation, with both countries also playing a very important role in also energy deliveries towards the West as a substitution for Russia. And basically also the fundamental picture of issuers in Qatar as well as in UAE is very solid. In Asia, we are very big fans of Indonesian corporate space, and in LATAM, we like Mexican corporates. And in CEMEA, our favorite spot is Kazakh corporate.
Sergey Dergachev, you heard it here first, folks. His picks of the EM corporate space of Union Investment. We thank you, as always, for your time and for your insight. Now, keeping up to date with news from around the world, here's the first word. Bloomberg's learned that Northwestern University professor Janice Eberly is a front-runner to become the vice chair of the Federal Reserve. Eberly was chief economist at the Treasury Department under President Obama. She would succeed Lael Brainerd, who was picked as President Biden's top economic aide. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power of the Supreme Court. There may be demonstrations in 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped his authority. JP Morgan is blaming former executive Just Staley for the bank's ties with disgraced financier Jeffrey Epstein, and it's demanding that Staley return all of his compensation for an 8-year period, more than $80 million. Just weeks ago, JP Morgan defended Staley against accusations he knew about Epstein's sex crimes. Staley has denied knowing about Epstein's abuse. Investing in luxury watches the last 5 years would have brought you a better return than if you had put the money into the S&P 500. That's according to a new report from the Boston Consulting Group. Prices for a basket of pre-owned watches such as Rolex and Patek Philippe rose by an average of 20%. It was more than twice the S&P's pace. People looking for apartments in Manhattan have seen little relief this winter from near record rents. The median rent on newly signed leases last month was $4,095, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. That's down just $2 from January and $55 from last summer's all-time high. And Anna, that's the first word.
Okay, yes. I mean, maybe if you bought a watch instead of the S&P 500 last year, you can afford to put that down, get you some way to getting one of those apartments. Kriti, that was the first word. Thank you very much for that. Now, coming up live from the Bank of America Global Investor Summit in Paris. We've been there all morning, hearing from a lot of key voices from both Bank of America and the wider political and economic space in France. Well, we'll broaden the scope of the guests now. We'll be speaking with the former House Speaker in the United States, of course, Paul Ryan. He'll be joining the team on the ground in Paris at that Bank of America conference. That's coming to us shortly. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Bank of America CEO Brian Moynihan has been speaking exclusively with Bloomberg at his firm's Global Investor Summit in Paris. He talked Brexit, recession, headcount, and more. Up next, we'll hear from the former U.S. House Speaker Paul Ryan and Bernard Menser, president of International for Bank of America. Credit Suisse puts its annual report on hold. U.S. regulators have some last-minute questions about previous statements. And President Biden wants to impose a 25% minimum tax on U.S. billionaires. In his budget request, the president also calls for a big jump in capital gains taxes. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. And some of those political headlines around tax, Kriti, you might expect those to put some downward pressure on stocks. We're seeing downward pressure on stocks, but possibly not for that reason, because maybe the Biden administration's plans will have a difficult path through Capitol Hill.
That and, of course, positioning ahead of the U.S. jobs report, all really leading to this idea of poor risk sentiment in the United States. You can just see that in the stock market. You see it in the bond market as well. Arguably, even the currency market, Anna, the weakness across the board seems to be the story. Futures are down about 0.3%. But check out the bond market. We're getting closer and closer, bouncing up against that 4% level on the 10-year yield. 3.99 on that note. But check out as well the inflationary story. They love to look at oil for this reason. Are we starting to see, even with this narrative of inflation inflation kind of coming down, a little bit more kind of progress in the CPI report, not just here in the States, but even around the world. China, for example, inflation easing in that part of the world as well. Nevertheless, NYMEX crude still positive on the day, only marked lead of what you're seeing in the kind of bond space as well. The dollar weaker by about 0.2%. A lot of that coming from Japan and the strength you're seeing in the Japanese yen. And I want to quickly hit some pre-market movers here because there are some big ones and they are all a doozy. Silvergate is the big one, down about 45% in the pre-market after shorts get almost a $780 million payday. The bank really can't catch a break as we start to see more and more outflows coming, really a kind of legacy of a lot of the chaos coming in the crypto space. SVB Financial is the other one that I really want to talk about. Down about 30% in the pre-market. This comes after a $1.25 billion share offering. They announced $21 billion worth of a security sale, kind of having a dilutive effect, but simply the margin of that issuance. And lastly, some analyst moving at C shares down about 5%, cut to underperform over at Jefferies, a price target of $85 a share, of course, trading right now at 107, Anna.
Chrissy, let's have a look at the European market then, and we're down 0.6%, so poor risk sentiment to Chrissy's point there, here in Europe as well as over in the US ahead of that jobs report. UK two-year yields just symptomatic of what we're seeing across Europe, those yields ticking higher once again as we continue to question how high this rate hiking cycle will go. What will the terminal rates be in various parts of the world, and how long, crucially, will we stay there? Credit Suisse down by 5%, another 5% lower for this business, which of course has been hit by waves of scandals over recent years, big restructuring at the business. Well, now regulators in the US have some questions that has meant a delay in the issuing of their annual report. That seems pretty rare, and as a result, the stock tax lower once more. Aviva in the insurance space in London. This is one of the only sectors, actually, Chrissy, that's doing pretty well today. Insurance lifted by Aviva, the company returning cash to shareholders and beating estimates.
A lot to keep an eye on the corporate space, on the kind of macro space as well, certainly in the political space, which brings me, let's go now to Paris, where the Bank of America Global Investor Summit is underway. Bloomberg's Francine Lacqua is there with former House Speaker Paul Ryan. Over to you, Francine.
Thank you so much, Kruti. Yes, I'm delighted to be joined by Paul Ryan. Thank you so much for joining us. We have 1,000,001 questions. I know you just also did a conference downstairs. We're here at the Bank of America conference. The debt limit, should the markets worry about this, Mr. Ryan?
I don't think the markets should worry too much. We will pay our bonds, we will pay our bills, but it's going to be a bumpy ride until that moment happens. It's not inconceivable to me that we go a little bit past the X date, because I think Treasury can prioritize. But once you get into prioritizing, the politics gets really ugly.
Yeah, but why go past that date if there's nervousness in the market and you just don't understand why the U.S. is in the state?
That is just how the politics of these things typically work. I've been involved in a number of these deals. Yeah. It is not rare to have fiscal reforms coupled with a debt limit increase. I don't think that's asking too much, frankly, by House Republicans. I was part of the BCA in 2011, and I was part of an agreement in 2013 that fixed this. So we have a debt problem. We have a debt crisis coming. It's a good idea to get something to get under control. And it's not going to be big entitlement reforms like Medicare and Social Security, but maybe they can get some fiscal caps, spending caps in place. But it's clear the Biden administration doesn't want to do that, so I think you're going to have a little bit of brinksmanship here. But at the end of the day, our bonds are going to be paid.
Okay, but is it right to bring it until the very end?
Probably. That's usually how these things go. I've done 2 or 3 of these deals. It was always like the day of or the day before.
Right.
It would surprise me if they saw this much earlier than that.
Okay.
But at the end of the day, we're going to make good on our bonds. Our full faith and credit will be maintained and intact.
So the message to the markets is stay cool.
Stay cool. We're going to pay our bonds. It may be a little bumpy. Maybe just don't watch TV for a day or 2.
Well, except for Bloomberg, definitely
except
watch
for,
Bloomberg.
Yeah, sorry.
You don't have to watch anything else. McCarthy's strategy on this, how do you see that developing in the coming months?
Well, I mean, his members, which I used to manage the same conference, want to see a budget advance that actually gets our fiscal house in order. So I'm happy that we have this revived concern about our fiscal problems. But you're not going to get a giant package through something like this, a debt limit increase. So the question is, can you get some pretty good incremental fiscal reforms in place, like, say, spending caps or some kind of financial mechanism to help get our debt going in the right direction?
And you think
we'll see what that looks like. I think it's possible. And the reason I think it's possible is because that's what we've done before in the past. So we'll see what happens then. But at the end of the day, we're going to really have to get serious about our debt crisis. Every modern country has this problem. And we can't keep piling on this kind of a debt because we're the world's reserve currency. We're not acting like a reserve currency, frankly.
Or is it playing with fire doing it at this time of market volatility because inflation is up and actually the Fed is raising rates quite aggressively?
It's suboptimal, I would say, but it is what it is. This always happens, especially when you have divided government. So hopefully cool heads can prevail, and hopefully the administration will agree to some kind of fiscal reforms that will help us put our debt in the right trajectory.
Is monetary policy on the right trajectory right now?
I don't think they have a choice. Yeah, I think January's numbers were pretty clear. It's going to be a lot harder to get inflation from 5 to 2 than it was from 8 to 5. And the Fed doesn't have a choice. What worries me is the fiscal policies that we could put in place, supply-side fiscal policies, make tax cuts permanent, increase labor market participation through immigration reforms, things like that. Those aren't going to happen. So fiscal policy is not going to be improved from a supply side standpoint. So it's really all on the Fed. And my guess is you probably won't get out of this without a recession. Get out of this getting to 2% inflation. It's going to take a long time, longer than people thought and hoped. And it's going to be a lot harder for the Fed to get to 2% than it was from 8 to 5.
So you think, is there a possibility that they have to crush the economy to get to 2%?
I mean, I don't like to use the word crush, but it would surprise me that we could get out of this, get to 2% without a recession. And the Fed cannot back off that 2% target. If they do, they'll lose their credibility. They know this. So that's why I think their terminal rate's probably going to be a little higher today than what we thought it was, say, a month or two ago.
But recession with a lot of job losses, or what kind of recession?
Hope not. I mean, it's been amazing resilient, the job economy. But if unemployment gets to something with a 5 handle, I think the Fed's going to have a little harder time getting consensus. So I think it's in Jay Powell's interest to get as many rate increases as he can right now. I frankly think they should have stayed with 50 basis point raises and not gone to 25. I think that head faked the market. It sort of pump faked the market. Hopefully they'll go back to 50 because get it now as fast as you can. Get the rate increases now that you have a consensus on the Fed. Because if we start seeing unemployment really starting to creep up past 4%, then I think it's going to be really dangerous and difficult.
I guess the danger is that there's a monetary policy lag.
There is.
And then that means a mistake, and then they have to.
Yeah, then they overshoot. The Fed's been overshooting. That's the story of the Fed. But I don't think the Fed really had a good thesis on how inflation works. They had the great moderation baked into their models. So I think the Fed was a little too late. They kept rates too low. They had too many asset purchases. Now they're making up for that. But it's really clear it is stubborn. And with decoupling happening, with delinking our economies with China to some degree and deglobalization happening to some degree, that stuff's all inflationary. So there's structural inflation baked into the cake, which means it's going to be harder, like I said, for the Fed to get inflation closer to 2% than getting it from 8 to 5 like they've already done.
How would you describe the mood in Washington, D.C. right now? From the outside, it seems like, I mean, we're not talking about not getting along. This is, even more than that. Is there anything that you can both parties can agree on to get done in the next 2 years?
I wish we had a better political climate. Our politics are pretty unserious. I just put out a book at the American Enterprise Institute showing how to get the debt under control, to preserve the dollar as the reserve currency. We're not doing those things because we have unserious politics. Yeah. The one thing I would say to that, though, is we are forging a bipartisan consensus on how to deal with China. I have a lot of confidence in party leaders in Congress right now, in this new committee chaired by a guy named Mike Gallagher, that there will be a bipartisan consensus on how to deal with China. So that is something that I think you'll see us working well together. There are going to be some bipartisan things, but it's mostly going to be revolving around our foreign policy. Our China policy and our Ukraine policy, I think, will still be bipartisan.
Okay, what will happen in Ukraine? More weapons, more money?
I think more weapons, more money. There's still a lot of support for that.
Both sides?
Both sides.
Is there a limit to that as we get into the presidential election?
There's a limit to how much our defense industrial base can produce,
right.
And there's a limit to how much we can get to the field on time to the Ukrainians. So, yes, there's a limit based on capacity. But I don't think there's a limit to our support, broad Republican support, broad Democrat support, for supporting our friends in Ukraine, to standing up against Russia. And there's obviously a lot of consensus on how to deal with China.
Who do you think will be the Republican candidates?
I think it's going to be somebody not named Donald Trump. We know that we lose with Trump. We lost the House in 18. We lost the White House and the Senate in 20. We lost the Senate again in 2022. We didn't win nearly as many seats in the House as we should have in 2022, largely because of Trump. Our voters more or less know this. So I think the fact that we want to win, we know we need to nominate somebody not named Trump, and if we do, I think we'll win the White House.
So who, if not Trump?
It's too early to say. I just don't know the answer to that question.
There's this big investigation, and of course the reaction from News Corp and Fox on how they dealt with allegations of the election. What's your take on that?
Donald Trump lost the election. It's really clear.
But Fox should have.
Well, there's a lawsuit. I don't want to get into pending lawsuit issues, but there are some opinion hosts that made their opinions, and there are people who, on behalf of the President of the United States, made claims. Those are newsworthy claims. They were faulty claims. But when the President of the United States has his lawyers saying things, that is a newsworthy event. Those claims were false. Donald Trump did not win the election, and he spread conspiracy theories to the contrary to that. And we all know that.
All right. Thank you so much for your time, Paul Ryan. There. With that, I'm going to send it back to you in New York, and of course, we'll have plenty more interviews from Paris throughout the day.
Yeah, absolutely. We'll be back with Francine shortly. Thanks to Bloomberg's Francine Lacroix in Paris. We'll get back to Francine after a short break. She'll be speaking with Bernard Mensah, President of International for Bank of America. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Well, that makes the Fed's job tougher, and that's the dialogue you have about how you can slow it down. But it all comes back to unemployment. Unemployment's low. Wage increases are still pretty strong. And you don't see that. New claims for unemployment, we'll see what happens this week. But, each week it's hovering at a level. It's very low, and there's some seasonality debate, but it's still very low if you thought you were really in a recessionary environment.
That was the Bank of America CEO Brian Moynihan speaking exclusively to Bloomberg's Francine Lacroix at the Global Investor Summit in Paris. Francine is back with us with another interview with Bank of America. Francine?
Yeah, thank you so much, Anna. We are delighted also to be joined by the president of Bank of America International. He's Bernard Mensah. Thank you so much for joining us, Bernie. First of all, congratulations on a wonderful summit. I know many people haven't caught up in a long time. We also spoke to Paul Ryan, the former House Speaker. So we're looking at politics. We're looking at, of course, Wall Street and banking. How's it feeling at Bank of America internationally?
It's feeling good. Thanks for having me on. There's a lot going on out there, and so I think it plays to our strengths because we can really work with clients across the globe and help them in a period where I think there's a lot of transition going on. So we're engaged, and part of the reason we had everybody come here was to just level set, get everybody up from their day-to-day, get a lay of the land, and then get back to their desks, I guess.
So is there appetite from clients to try and do more, or are they sitting on the sidelines in terms of deals and in terms of expansion just because they want to understand how inflation pans out?
I'm finding clients super engaged. I think that they're thinking through. There's just so much that has happened, apart from the COVID and the energy transition and capital flows, the macro issues around what central banks are going to do, not just with rates, but just with the absolute levels of their balance sheets. And so all of those things mean that I see clients super engaged, thinking, planning, and just trying to position themselves for just transitions in so many of these sectors, whether it's tech or pharma or capital flows. So that's good.
So what does it mean for expansion from Bank of America? If you want to be closer to your clients, are you targeting industries or actually regions?
It's across the piece. So in Europe, where we are now, in a way, our investment in Paris has meant that we're that bit closer to our clients. I think it's terrific, the feedback we're getting in terms of what they need, our ability to deploy our resources and help them think through broadly is terrific. And then when you go internationally, as I do, I think those cross-border flows are terrific. There's a lot going on in the Middle East, places like Saudi, and as you go further across in Asia, you have the IRA and the Inflation Reduction Act, which means that given that we have our U.S. base, we can really engage, in that dialogue. So for us, a lot of it is really delivering the incredible resources we have in the investments that we've made as a firm to our clients. From where I sit, I just see the breadth of that, and the challenge really is getting to them as quickly and as best as possible.
So is also money flowing to where it should be in terms of, if not fundraising, certainly the clients wanting to access capital. Is that working as it should? Or again, are there questions marks because of this, I guess, change in markets because of flying interest rates?
So that's really interesting. I think that the money flows, and it's something that maybe from my background in fixed income, I've been thinking through. I think that's super interesting. Now, the public markets haven't done so much. Private markets have slowed down a little bit on the back of that, but there's still a huge amount of excess savings out there. Where those savings are, so I'll give you a couple of trends. One is, Germany is running a deficit for the first time, right? A current account deficit. I think last year was the first time, maybe this year. Where are those deficits? So Europe, as a perennial sort of accumulator of savings and capital, hasn't done that in the last period. So it's importing capital. It might be repatriating some of its capital. Some of that is going to the Middle East, and a lot of that is to do with the energy shock. So that's one interesting aspect. And then if you take central bank balance sheets, the ECB has started to reduce its, the balance sheet increase was huge because of COVID, and some of that dwarfed actually all of the QE. So if you take the EU, which might bring its balance sheet down by about $1 trillion by the end of maybe next year, that's, 15% of EU GDP. So those flows are really interesting, and I think our clients will have to, and asset managers and investors need to have that backdrop as they manage, their investment decisions.
Are we underestimating actually the impact that the war in Ukraine has longer term for the energy complex? And therefore, we mentioned the Inflation Reduction Act, but actually the way our economies work going forward.
I'm not sure if we're underestimating. It's a good point. I think when it happened, the immediate issue was, would we get through the winter? And I think Europe did a terrific thing there. I think broadly speaking, then the question is, what's the energy mix in Europe? And what's the cost of energy for a European economy that is quite energy intensive? So I think a lot of people are thinking through that. When I talk to CEOs and some of the government officials, they absolutely are thinking through that. And I wouldn't say wargaming, but strategizing over the next period of time around that. And other energy provinces are having to sort of think of whether it's the US or the Middle East or elsewhere. But it's also accelerating the ESG dialogue, because I think Europe in particular is thinking that over the next period of time, without Russian oil and having to think through other things, actually, there's even more reason for transitioning to clean energy.
Do you have a lot of your international clients actually wanting to put more money in the U.S. because of the Inflation Reduction Act, instead of either in their home countries or elsewhere in the world?
That's a good question. I certainly think that the Inflation Reduction Act has, for a lot of European clients I've seen, has really made them think about that as a possibility on its own. But I'd also say that it's within Europe as well, and elsewhere in the world, has made people think through. Europe has a huge amount of money or resources to put to incentives and tax breaks. So then you have some of the conversations around the effectiveness of how quickly you make things happen, how quickly you get your approvals through, and the framework for investment decisions to be made. But certainly it started an interesting dialogue in C-suites, certainly.
Bernie, thank you so much for joining us today. That is Bernard Mensah, of course, the Bank of America President International. So with that, I'm going to hand it back to you in the studio, and then we'll have plenty more interviews from here throughout the day.
Thanks very much, Francine. Bloomberg's Francine Lacroix in Paris, of course. Coming up next, we'll run you through the key events that we're watching in your trading diary in the day ahead. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's ahead in the trading session at 8:30 a.m. Eastern. We're going to get initial jobless claims data, some sort of precursor perhaps to the jobs report tomorrow. At 10 a.m., Norfolk Southern Railway CEO Alan Shaw due to testify in front of a Senate panel about the derailment of one of the company's trains in East Palestine, Ohio. A very political and controversial move here in the States. Also later today, President Biden will unveil his budget proposal. Officials say Biden's plan will show a commitment to cutting the deficit. Anna, it's that Biden story that's going to ruffle a lot of feathers on Wall Street, especially the folks that make the big bucks.
Yeah, absolutely. Interesting to think about what it means politically, but also how likely it is, given the politics on Capitol Hill, of course. Another story that caught my eye, Kriti, and you won't be surprised to hear that this has proven to be a very popular story on the Bloomberg terminal this morning. Rookie traders in Sydney, in Australia, some of them taking home $400,000 a year. And this is straight out of college, straight out of university. This isn't just any old job, though. This is tech-driven trading, and the city turning itself into a bit of a hub for this. Businesses like Citadel, IMC, Optiva. I mean, on a cold and foggy March, are we in March day here in London, Kriti? This is the kind of story that really makes you question your life choices.
It really does, and I may imagine a lot of folks in New York are reading the story and thinking, I want to move to Sydney as well, simply because you can have that same job here in the States and not make that kind of dough. $100,000 to $120,000 is the base salary for the same role here in New York, and a lot of folks are saying, look, it's the Australian college system that just breeds really strong candidates for the trading floor.
It does seem to have turned itself into a bit of a hub. Really interesting story by our colleague Patrick Winters then. Dig it out on the Bloomberg terminal. Interesting to find a section of finance that is still recruiting. They are still recruiting in this part of the world and this part of finance, not the message we're hearing from lots of other big players in banking, of course, which is more about job cuts. So that's the focus today. The focus tomorrow, of course, Chrissy, will be on jobs of a different variety, the jobs report.
It absolutely will, and it's going to be fascinating when we hear what does a hot labor market look like when it comes to the markets, or is it all priced in?
Yeah, absolutely, after that JOLTS report of yesterday. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. They'll be speaking to Christian Muller-Glissman of Goldman Sachs, among others. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Data that is really having trouble setting us a clear signal.
The adjustment we've seen in markets has been quite small, given the news that we have from Powell.
It's important that he laid out just how data dependent they are and the willingness to pivot.
The Fed talks too much. I have thought that throughout this whole cycle. There's too much talking, too much talk of disinflation.
If we are going to consider re-accelerating to 50 based on the data, and they are very data dependent, the risk of a hard landing does go up.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Chairman Powell, day 3. Can you imagine that? 3 days of that?
I actually
no,
think
thank
that
you.
no one
No,
wants
thank
that.
you. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity futures on the S&P. We're down about 0.2%. TK, it's all about the data now. Jobless claims a little bit later. Payrolls tomorrow.
You know, claims after the ADP report, I still don't know what to do with ADP. Full disclosure on that. The JOLT survey, clearly the zeitgeist says that's what we paid attention to yesterday. It sort of sustained where we are. But, John, I'm going to call it quiescent Thursday. We're into where we're waiting for claims and then jobs.
Just a little bit of daylight between day one of testimony on Capitol Hill for Chairman Powell and day two. Some ifs and buts at the top of the statement. Some ifs, some important ifs here, Lisa.
This is Jay Powell trying to wiggle himself out of committing to a 50 basis point rate hike. The funniest part about it was the market didn't buy it in any way, shape, or form. They actually increased the chances of a 50 basis point rate hike. This was Jay Powell trying to say, don't just move off the jobs report. There are other things too. People are like, okay, we're just going to move off the jobs report. But basically, there is this feeling he's going to say one thing and markets are going to do something else.
But isn't JOLTS signifying a fully employed America?
JOLTS came in, headed in the right direction. They probably see that as improvement. The quits rate fell a little bit as well, but still way, way too elevated for this Federal Reserve. Jobless claims we're expecting something in and around 200K again. And tomorrow we're going to get payrolls, and the estimate so far is something in and around 200,000.
The problem is every single data point we're getting, there's something for everyone. You can confirm your narrative no matter what you look at. If you look at the JOLTS in particular, it's a perfect example of that. Headline number came in hotter than expected, bad for the Fed, but the quits rate came in lower than expected. It declined more than people expected, good for the Fed. You can choose your narrative, and the Fed basically says, we don't want to get involved, but they kind of have to, and that's the problem.
Should we squeeze in some Credit Suisse news?
I think we've got to look at the Credit Suisse
Can you find
narrative.
or remember a day when you got some good news for this bank? Credit Suisse has delayed the publication of its annual report and compensation details for 2022 after US regulators raised last-minute technical queries, Tom, on previous statements.
You know, I looked at a weekly log chart, and again, this is in Swiss francs, which proxies to the dollar pretty well. And basically, John, this is 10 on a moving average basis, maybe even $11, 11 Swiss francs per share, down to 2.5. I think that's a 75% decline since the beginning of last year. How long can they sustain it? And if, this chart is there's no higher high or higher low evident.
Oh, it's ugly, and the hits keep coming. That stock is down by almost 6% right now, 250. 250 Credit Suisse.
Hold on, it's coming. I didn't pay the mouse today on the terminal, excuse me. Price to book, 0.16. 0.16.
Yeah, that's a problem.
You know, and I think we've got to listen to John Patrick when he's on today about the future here, like the future into April.
We'll catch up with the team over in Europe a little bit later this morning. Good morning to you. Let's whip through the price action together. Equity futures negative about 0.25% on the S&P. Lisa mentioned just this bond market shrugging off everything Chair Powell had to say yesterday. Yesterday, your two-year yield higher for a third straight session. Today, we come back in just a little bit. We're down 4 basis points on a two-year, 5.03% on a 10-year. Basically unchanged here, Lisa. Your 10-year, 398.55.
So it's not perhaps day 3 of Jay Powell, but it is day, whatever you want to call it, of data dump that we could potentially sift through and get some sense of the narrative that we want to confirm. We get challenger job cuts at 7:30 a.m. Do we see job cuts starting to increase as you start to see the quits rate decrease, signs of a tightening labor market, and then initial jobless claims that come out at 8:30 a.m. Do we still see incredibly low numbers? And then, of course, at noon, we get the fourth quarter household change in net worth. How do we really get a sense of a cohesion in the narrative if it is sort of a choose your own adventure kind of picture that is backward looking? 10 a.m. we hear from Fed Vice Chair for Supervision Michael Barr. He's talking about crypto. I'm sure we'll hear about Silvergate. We're going to be speaking about that later. And then later on in the afternoon in the United States time, but in Japan, into Friday, it is the last Bank of Japan meeting with Governor Kuroda at the helm. Not expecting necessarily a huge move, but to me, I think this could be really telling as we prepare for the Ueda era, especially given the fact that there are some pretty big bets accumulating about the yen and the direction it will follow. And today, President Biden will be releasing his budget proposal in Philadelphia. We'll be talking about tax increases. We'll be talking about some of the proposals that got cut in the proposal that he had last year. none of this is going to get passed. We're going to hear from Anne Marie. She's going to say it's all dead in the water, basically, things that are talking points. But what it does signal, perhaps, are the lines being drawn ahead of the debt ceiling debate, John. And I think that that's really where we could get some real information about how those negotiations will go forward.
That's not a budget, Tom. That's not a budget. That's a campaign speech.
It's a campaign speech.
A little bit later.
What's the 25% tax on billionaires? On their income?
Are you concerned
on their
about
wealth?
that?
Yeah, I'm worried. I was up all night worrying about it.
Well, we have discussed wealth taxes before. They're very, very difficult to implement.
In America, hugely
Massively
difficult.
so. Hugely.
I assume
they get a lot of
United
support.
Kingdom, too.
I should expect them to, because many people aren't billionaires and they see that as a good source of tax revenue. But ultimately,
From
very,
the
very
42
difficult to
guys that are
execute.
billionaires.
I think this actual number is closer to 700 to 800 in America, yeah.
Really? I did not know
something like that, according to Forbes.
Okay. They all
that
play
enough?
in Major League Baseball.
We've done that. Did any billionaires in Major League Baseball?
I don't know. I mean, so Mr. Jordan in basketball is.
I'm sure they're making real money.
No one on the tots is.
Well, we'll talk about Spurs a little bit
We
later.
will. Let's
we'll
go.
save that. Steve Chevron, Head of Multi-Asset Solutions and Senior Portfolio Manager at Federated Hermes. Steve, let's start with this equity market. Just why is this NASDAQ leading?
Well, hold on. Before we go there, I just want to say I wish I was a Major League Baseball player. That was the original plan. This was the backup. So, look, I think from a market perspective, what the bond market did this week was different. And I think that's why you saw the NASDAQ as resilient as it was. And that was, in prior hawkish episodes, you'd see both the 2-year and the 10-year sell off. They both would sell off. The 2-year would sell off a little bit more and the curve would invert some. In this case, the 2-year sold off, but the 10-year held serve. And I think what you're starting to see the bond market at least try to sniff out is this idea that this more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish, a higher terminal rate, and that raises the risk to growth tomorrow. And in that environment where you are pricing a growth slowdown, you probably don't want to be quite as underweight growth as you would be in just this unending inflation environment. And I think that was a little bit of the sniff out. I wouldn't make too much of it, with a day or two, but that was my read.
See, the Federated Hermes has a timeline that's appropriate, 3 years, even 5 years out. Let's talk about that growthiness right now. You guys are acclaimed. And this really, folks, goes back to Pittsburgh in 73, 74. You're acclaimed of getting out front on gloom. When do you go growthy? What is the signal you need to see to climb back on growth?
So, Tom, I don't know if it's growth that we climb back on, and that's not because we're trying to be gloomy. When you look at the experience of the last couple of years and you think about what's been scarce or what's changed, right? You've seen supply chains be reconfigured. You've seen re-onshoring, 500 to 700,000 jobs per year now. And when you look at what's scarce in this economy, it's really not growth or technology. What's scarce is that which was old. Think about, we don't have enough infrastructure in this country, whether it's energy, whether it's materials. If you're going to be producing more in the United States, there's probably going to be a lot of demand for industrials. You're going to need financing for that from banks. So at this point, our bias is that once we are through whatever economic slowdown that's going to follow this kind of hike cycle, we think really the next set of leadership is going to be cyclicals, not growth. And if you think about it, it makes sense historically. You didn't have tech lead you out of 2000. You didn't have banks and real estate lead you out of 07, 08. And we don't think it's necessarily going to be growth that leads you out of this cycle. We think it's going to be the cyclicals. What's old will be new again. And that's where I expect we'll take our long-term kind of bullish bets. We're not there yet, but that's the direction we're eyeing.
That's within the equity portfolio. Just more broadly, how much more weighted are you to the fixed income side at the expense of your previous equity allocations?
Mm-hmm. So, we've been accused in the past of being permabulls, and we've been pretty conservative for the last, year plus. But we're not over our skis in terms of being massively underweight equities because we still don't think we're through this period of volatility. And historically, when the Fed pauses, you can get a 15 to 20% rally. So we find ourselves kind of neutral-ish stocks versus bonds. What you'll see in the fixed income, though, is a very defensive positioning. Trying to get aggressive in fixed income ahead of a growth slowdown, Lisa, is like picking up pennies in front of a tractor trailer. So we're neutral-ish with a bias towards being long on the duration call. And we're about as underweight credit as I remember us being in the 15 years I've been here, there's only two other examples that I've seen as this underweight credit, and that's 07 and 2019. In particular, I think if duration was the risk that defined bonds in 2022, I think credit risk could increasingly become the risk that defines bonds in 2023.
Steve, I'm so pleased we didn't lose you to baseball. Thanks for being with us. Steve Chevron there, a Federated Hermes on this market. He's not alone. Oksana Aronoff of JP Morgan Asset Management yesterday just saying no thank you to credit right now. In her view, high yield spreads have no business at the 400 basis points.
I don't know where to go. I read carefully the Johnson & Johnson Kenvue deal yesterday. That's like Lisa Bramowitz territory.
Right.
And I really studied it. It was 6 times oversubscribed, and where it fit in with other, this is Band-Aids, Listerine, Aveeno. That's the products in this new spinoff. And it fit in superior to all the other consumer good companies. The appetite out there for bonds,
for income,
here,
that's huge.
Stunning.
Okay.
Stunning.
Huge.
So if you're reading the prospectus of an 8-part bond offering, did you also read the beige book? Are you also going to read the notes of things? I mean, I'm just curious.
That's on the edge of minutes. And in honor of the late Richard Yamarone, I just go to the orange book that Bloomberg invented, which is more informative.
So you avoid the beige book?
I avoid the beige book.
That's good to know.
Several minutes I avoid.
Nice.
I do listen to the chairman, though. I thought that was fascinating.
You actually watched some testimony yesterday?
Yeah, day 3 will be something.
That's good. I'm pleased you've caught up ahead of payrolls. Christian Muller-Glissman of Goldman Sachs is going to join us in the next hour. Equity futures look like this on the S&P 500, down around about a 0.2% or so. No real drama here. Yields down about a basis point, 397.96 on a 10-year from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. On day 2 of his testimony on Capitol Hill, Fed Chair Jerome Powell softened his tone slightly. He said policymakers will wait for new jobs and inflation data before deciding how much to raise interest rates later this month. Still, Powell repeated his message that the Fed is likely to take rates higher than previously anticipated. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power to the Supreme Court. There may be demonstrations in 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. And JP Morgan is blaming former executive Jess Staley for the bank's ties with disgraced financier Jeffrey Epstein. And it's demanding that Staley return all of his compensation for an 8-year period. That's more than $80 million. Just weeks ago, JP Morgan defended Staley against accusations that he knew about Epstein's sex crimes. Staley has denied knowing about Epstein's abuse. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 Oh, my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, Friday on Bloomberg Television and Radio.
Made any decision about the March meeting. We're not going to do that until we see the additional data. Larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook. No decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Some ifs and a couple of buts. That was the difference between day one and day two on Capitol Hill for Chairman Powell from New York City. You okay there?
I'm fine. No, I'm not okay.
What's wrong?
I read my first article. I think I have to blame the Telegraph in London. And, you know, like AC Milan's not even back to Milan, and they're already talking about the Kane exit. I mean, this is a huge... I'm not thinking clearly today.
Okay.
The Tots have blown it.
Yeah.
They have a very sick coach. Some guy just out on Twitter thinking Beyonce ought to step in and coach the rest of the season. Yeah,
maybe.
You know.
Let's pick up on that later.
Yeah, let's do it.
If you're just tuning in, good morning to you. Let's get you some price action. Futures down about 0.2% on the S&P. Yields unchanged, Tom. 3.98 on a 10-year.
It is. It's you know, the data flows there. And John, I think we're finally to where it's the weight. I mean, we make jokes about countdown clocks. But, you know, I'm sorry, we're there. It's 2 hours and 15 minutes, and now everybody's just waiting.
A couple more hurdles. We get claims a little bit later. Lisa mentioned that, 8:30 Eastern time, then on to payrolls tomorrow, and then it's on to CPI on the 14th and the Fed on the 22nd. One little wrinkle for the Federal Reserve is that the 14th, the CPI print comes in a quiet period. So no Fed speak around there. That Fed speak ends after Friday.
When's the quiet period end?
Starts Saturday,
June?
and it will end after the Federal Reserve meeting, Tom, because the chairman will come out and snap that quiet period for you. You won't be here, though.
I'm not going to be here.
We'll miss you.
I have to go away. Afterthought said nope. And that's what we're doing. Right now, we're going to go to Washington. Anne-Marie Horton is with us. She's had a very difficult night. She's our Bloomberg billionaire correspondent and joins us. You've seen her on Billions. Anne-Marie Horton, you know, and it's good, Anne-Marie, to see that you're going to be taxed at 25% along with the rest of the billionaires. What in God's name is going on? For we mere mortals, when the president of the United States comes out and says he's going to tax billionaires at 25%, what does that mean?
Well, this is going back to something the Biden administration tried to push forward. Remember, during Build Back Better, when they first got into office, a lot of these tax hikes and provisions could not get through to a democratically controlled House and Senate. So this is, as Greg Valliere and everyone else has put it, dead on arrival. But Greg Valliere this morning says it's purely aspirational. And I think that's really how you need to view today's budget. In recent years, a lot of these budgets are pretty much dead on arrival. But it shows us two things. One, this is, as Jonathan called it earlier, a campaign event. The president is expected to make an announcement for 2024. And this really foreshadows the future of how the Democratic Party views fiscal issues as well as where they see room in the tax code to raise taxes. Secondly, it's a way for the president to outline his plan. He's probably going to say he wants to make sure to keep entitlements like Social Security and Medicare solvent. And it's a way to start that debt ceiling debate with the Republicans. And then, of course, we have to wait for the Republican response and their budget.
Tell me about the shade of Democrats here. I mean, I get the idea the left wants to tax evil billionaires. That makes sense as well. But, Anne-Marie, where are centrist Democrats on this? Where's Manchin on the edge of Democratic and Republican?
We know where we are. I bring this up a lot, but the Democrats had a chance to close something that helped venture capitalists and private equity managers, which is the carried interest loophole. They were able to narrow that tax in August, yet to get one centrist on board, then Democrat, now independent, Kirsten Sinema, they had to drop that. So this just goes to show, while that is why it is aspirational, it is a ton of measures. None of them will get through. Maybe if there's potentially one, but no, this is not looking likely for any of these measures that they're going to announce today. But it shows how wide the spectrum is based on what happened in August, based on what President Biden is going to announce today, how wide the spectrum is in the Democratic Party, but also how hard it is to govern when you have such slim majorities on both houses.
Talking about a campaign event, I wonder if we were having day 3 of Jay Powell testimony on Washington, on Capitol Hill, whether the focus would be more on their failure to curb inflation so far or the potential for job losses as they raised rates, which resonates more with the population in America.
It depends what lawmakers asking the question, right? The Republicans want to continue hammer the Fed about inflation and what they say was driven by excessive spending of the Biden administration. That is their line. The Democrats are very worried about going into 2024 and potentially job losses in a recession. And remember, yesterday was a little bit more political even than we saw in the Senate. And that is because also the nature of the House. These are lawmakers that have 2-year terms. In the Senate, it's 6 years terms. So obviously, you saw a lot of political questioning to Powell about inflation that's hurting everyday Americans, about people that are potentially going to have job losses, about mortgage rates, about climate, about capital requirements. This would be day 3 of pretty much the same. But more interesting, we're going to have Treasury Secretary Janet Yellen on the Hill Friday morning. This comes after Biden's budget. And really the question for her from lawmakers is going to be if she could precisely map out when we are going to hit our debt limit.
Another thing that we're going to see in Capitol Hill today is the Norfolk Southern Railway CEO. He's going to be talking about the derailment in East Palestine in Ohio and some of the other concerns that we've seen percolate out. Is there a greater willingness on both sides of the aisle to pass certain safety measures that railways have to implement that have previously been shot down before this derailment?
Mm-hmm. Yeah, I mean, a lot of the Democrats are pointing to this kind of regulation that was rolled back during the prior administration. There is a growing chorus, more bipartisanship when it comes to this issue, right? And you saw both parties try to take this train derailment in East Palestine. Then there was one outside Springfield, Ohio, just weeks later, and put a focus on these kinds of issues and these kinds of safety issues. When you have the media talking about it and you have politicians flocking to Ohio to talk about it and make this campaign events a la the former President Trump giving out Trump water in East Palestine, you now see really growing support that more needs to be done. And if they're not able to pass the regulation, at least today, there will be a grilling of the CEO.
Anne-Marie, thank you down in Washington. Looking forward to the conversation a little bit later in the next hour. Elisa, we've got to talk about what's on the horizon here. It's pretty clear that we're going to have a debt ceiling crisis in the United States. What's difficult for a lot of people in this market is it's too early to prepare for it. Chairman Powell kind of laid the groundwork a little bit over the last couple of days. What was that phrase? There's no rabbits out of the hat. Right. There's no rabbits out of the hat here. They need to do something.
Here's the problem. Every single time there's been an issue with the debt ceiling, they've solved it. Every single issue, they took it to the last minute, and then it was solved. This time, people feel like the lines are more entrenched, and this is actually one of the campaign points among certain Republicans who say, we do not want to expand the budget, and we will go to our grave saying that. And that is just their campaign. That's their platform. So this becomes a much more difficult sell. What's the response to it? People are just ignoring it because they have no idea, and we're not there yet. But it does feel slightly different.
I'm going to give you a singular response, and CBO lays it out. I do not have, John, the numbers memorized in front of me. Guess what? Interest rates up. Guess what? Interest expense of debt. Guess what? These are, I thought they were summed cumulative numbers to borrow from Brainerd. No. Per year, it's unimaginable, the interest cost out 10 years now that rates have normalized.
Well, I think Chair Powell was very specific yesterday. It's about the growth of debt that's unsustainable. He said the debt as it stands is sustainable, but the growth of debt is unsustainable. Is this the time to do something about it? No, because these spending agreements have all been agreed in Congress previously. This is spending we've already agreed to, and this is always the frustration when we come round to this debate on Capitol Hill.
It's the reason why some people are looking at the Biden speech today as a roadmap for how they plan to solve this, because there are two ways to deal with this: cut spending or raise revenues. How do you raise revenues? And I think that's what he's trying to address.
Coming up, Rabita Faruqi, the chief US economist at High Frequency Economics. Looking forward to that conversation. Futures on the S&P down about 8 points. We're negative 0.2%. From New York City, it's a Powell-free zone on Capitol Hill. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equity futures a little bit softer here. We're down about 0.2% on the S&P 500. Likewise on the Nasdaq, we're down about 0.5%. Just a little bit lower, negative down a touch across the board here in the equity market. Confronting some big moves in the bond market over the last couple of days. Your 2-year, 10-year, 30-year shaping up as follows this morning. The 2-year retreating a little bit. We're down 4 basis points on a 2-year. Still north of 5%, 5.0283% over the previous 3 days. Yields higher. This morning, yields just a little bit lower at the front end. So the curve re-steepens just a bit. But look at these levels, though. Twos tens, negative 104 still. Yesterday, briefly, after ADP, we dropped through negative 110. In the FX market, just to round things out for you, Tom, euro-dollar shaping up as follows on the euro side of things, just a bit stronger. Against the dollar, euro-dollar 105.78, still sub 106 going into payrolls tomorrow morning.
I don't get much from currency, John, but I'm glad you mentioned 2's10 and that we went out to 110, 111, we come back. But still, look at the screen. I'm sorry, 3 days on, it's a shock.
These are big levels, Tom.
These are big
5 at the front end. And then you had the likes of Rick Reeder over at BlackRock floating just the idea that maybe we have to go to 6 on Fed funds.
Yeah, did you see Liz Ann Saunders tweeted Atlanta GDP now?
Where are we?
Modeling 2.6%, and it's a calendar item. We're in March. That's pretty good data in March.
Speaks to the resilience of this economy.
It's distant from recession.
Speaks to the argument we've been having just about how rate sensitive this economy may or may not be.
Yeah, we'll have to see. It can be 20/20 hindsight here. We're going to go to it right now. And Rabila Faruqi is going to give you a wonderful brief. She can do this off the heritage of high-frequency economics, which is hyper-detailed notes looking at the granular data. Rabila, I want to go to one thing you alluded to, which is everyone, including you, doing the 20/20 hindsight look back of what they should have done at the last Fed meeting. We're more informed now. Is it just a layup that they should have gone 50 at the last meeting?
Good morning. Thank you for having me on the show. I do think that maybe it was a little premature moving down to 25, moving down so quickly, slowing the pace to where they did. Because we really don't have much clarity right now in terms of the growth trajectory. We know that growth is positive. We know that the labor market is extremely strong. And we know that there are sticky components to this inflation that we're seeing right now. So, maybe it was a bit premature, but, the Fed has done a lot. And I think they're very concerned, as much as they are focused on inflation, they are not insensitive to what, the effect on the economy will be. The problem is that monetary policy right now, if you look at where the inflation is showing up, that's really not very responsive to what they're doing on the rate side, right? In terms of demand for travel, in terms of demand for, going out to restaurants. I don't think that that's, that part of the economy is really going to respond to, further hikes in interest rates. But that's the only tool they have. That's what they're going to have to do.
When we look at the American economy, and if we assume the consumer is buoyant, which gets you out to an Atlanta GDP now 2.6%, when we finally get to slowdown, does consumption drift away rapidly?
And that's the question that we're trying to answer. So on the one side, we expect to see job growth slow. We expect to see, some moderation from interest rate hikes, especially when you look at, what consumers are facing in terms of credit card debt, in terms of credit card interest rates, auto loan interest rates, tighter lending standards. So we do think that stress is going to appear. But on the other side of it, we're seeing real disposable incomes that are now positive. If you look at the recent months' data, and if you look at it on a quarterly basis, so there is still support for the consumer. But we think that, eventually these excess savings are going to wind down, and that eventually, this high interest rate environment is going to be a constraint on consumers. Like I said, we've been in the camp that growth is going to remain positive and that the consumer is going to remain resilient. It's just that the pace is going to slow probably, maybe in the second half, maybe starting in the second quarter. But, we've been growth, spending, these things, they've just surprised to the upside. And it's been very difficult to predict when that pushback from the consumer is going to come.
It seems like right now analysts are toggling between a no landing type of scenario or a delayed recession type of scenario. And I guess the issue that I have is if we get a delayed recession, will it inevitably be deeper? Because it means that in the meantime, the Fed has had to do more in terms of raising rates or even potentially shrinking their balance sheet.
Right. And that's the other thing that we're trying to, assess is, if the Fed is really, not seeing the improvement in inflation, and we don't think we're going to see the improvement in inflation, not a substantial improvement anyway, you have goods prices that are eventually going to stabilize, towards that 0% contribution. You have a service sector that's still accelerating. The housing component of it, that is not going to slow down for a while. So, you're going to see that sticky inflation, which means that the Fed goes harder, and the probability of, a recession over tightening and a recession goes up with that. I'm not really sure what this no landing scenario is really, if you're going to see growth, that's going to be stronger. If you're going to see inflation, that's going to be stronger. The Fed is going to go more. That means that the hard landing scenario becomes more of a reality. Again, like I said, I don't see negative growth this year. We still think that the U.S. economy, the fundamentals still support positive growth. It's just that there's a wide band of uncertainty around how far the Fed is going to go, how long they're going to stay there, and what that will mean for economic growth.
If I were to sort of characterize Fed Chair Jay Powell yesterday, he basically came out and said, please give us a break, okay? We might go 50, we might not. It all depends on the data, but don't look too closely at one data print. Look at all of them, and God, would you guys just chill out? I mean, honestly, he was trying to basically push back against everything and hedge, and it really just raised the conviction in markets that he was going to go 50 basis points. From your perspective, how low is the bar with respect to the payrolls report tomorrow to get a 50 basis point rate hike from the Fed?
And this is the challenging part, right? I mean, they stepped down to 25, and now we're still looking at a labor market that is extremely strong. 200,000 on payrolls is an improvement, but it's still too hot in terms of, what the Fed wants to see. We're also looking at the wage data, not consistent with the 2% target. We're also looking at inflation. We don't think that next week's numbers are going to show a substantial improvement on core prices. So I do think that they can go 50. We're also looking at the retail sales numbers. We're also looking at industrial production that's going to be reported next week. And we think we're going to see a slowdown over there. So how the Fed balances those things out, he talks about the totality of the data. I think the totality of the data will show that the labor market is still strong, inflation is sticky, but that there is some moderation in terms of household consumption. And they have to balance, it's a very tricky situation that they're in. But I think at the end of the day, I do think my base case is that they do stick with the 25. But if there's an upside surprise tomorrow, and if there's upside surprise on CPI, the 50 is definitely on the table.
I want to go to your heritage and the granularity that you've been known for years. Are we becoming a nation of bartenders? I mean, I look at the hospitality and bar growth, and I get it. We're coming off the pandemic and that. Does the Fed and do you care about the quality or character of jobs?
Yeah, absolutely. I mean, but like you said, we are seeing strength across sectors. This is not just about leisure and hospitality. This is not just about, the sectors that were affected by the pandemic. This is really about pretty broad-based strength. We do care about that. We think that, what we're seeing right now, we're still seeing pandemic effects, but really there is resilience. And in terms of where this economy is, look at construction, look at manufacturing. We've seen a huge adjustment in housing, but we still haven't seen declines in construction payroll. So how long is that going to last? That's what we're trying to assess. It's really not clear right now.
Rabila, I'm not sure anything is clear right now. Rabila Faruqi there of High Frequency Economics. Payrolls tomorrow, previous number 517, median estimate 225. Question now is not how high is the bar for 50 basis points. It's how low is the bar for 50 basis points, even with that slight step back from Chairman Powell yesterday.
And that's entirely Jay Powell's fault. And I will argue that he basically laid the groundwork saying that everything's been coming in hotter. Well, no, I mean, that's what he was trying to back away from yesterday he was like, wait a second, maybe that's not how I wanted to come across. I wanted to give ourselves more room. But clearly they're concerned about the lack of progress they're making. And so, if that's the case, why not go further if all of the upward revisions that we're seeing continue for the previous months as well?
Makes you wonder, who do they run this testimony by internally at the Federal Reserve? Who read that on day one?
Or
it doesn't make sense.
Who doesn't understand what the markets read is going to be?
Clearly there's a disconnect there.
And I think that that's really the issue, and that's been a tension consistently. They don't know what they want to signal to markets, and if they don't have that that clarity, then you get some of these communication issues that get borne out in market pricing.
So this is going to sound really, really harsh. It's not meant to, but if that's an area in your expertise that you lack, why lobby to have an economist at the New York Fed and not someone who understands markets, someone that you can speak to and rely on?
I'm not going to answer that. I'm going to punt that one. But
by all means, you can. But that's what happened with this Federal Reserve. It's well reported and well understood.
I would say there is a tension between understanding how much the Federal Reserve cares about the market's response to what they do trying to lead versus trying to follow. There is this consistent tension that's been there for the past year. And I think that that just continues with this feeling that perhaps they're not trying to job on the markets until they are.
I just found the communication, Tom, over the last couple of months pretty bizarre.
Months. I would go years, and I would go back to the advent of the dots and all this speakathon that we have every 6 weeks that Lisa's been great about keeping up on. I just think there's too much communication. And what's interesting here, John, is they have a historic data dependency, and now that we're much more restrictive with the seismic move in rates, the markets have caught up to this insane focus on data. It's always been there. It's just now in very bright lights.
So I think the radical transparency coming out of the financial crisis made sense. They became so powerful through the financial crisis and afterwards. And also they wanted to use forward guidance to really bring interest rates down, lower for longer, a whole lot longer. Now what's happening with the forecast, it's not so much about the dot plot, it's the fact they're projecting higher unemployment. And that seems to be part of the objective. And that's where they're going to get in a little bit of hot water down in DC, and I think we've experienced that over the last couple of days. This just gets worse, though, doesn't it? I mean, let's face it, this is happening now with 3.4% unemployment. What do those testimonies sound like if Chair Powell sits down again and that's got a 4 handle or a 5?
This is the reason why there are people who think that perhaps you could see longer-term yields go up, because there won't be the conviction at the Fed to go all the way because of the concerns about the employment picture. And that's sort of some of what people are trying to game out. The problem with radical transparency at a time of such uncertainty is the Fed doesn't know. They're arguing about their framework, they're arguing about the models to follow, and they're arguing about the historical analogs. So radical transparency doesn't leave us with much clarity.
It's clear that the job is easier when inflation is really low, and you just have to sort of max ease. And I remember the days when they would say, yeah, but we know what to do when inflation is too high. We raise interest rates, and this is the world they're struggling in.
Here we are.
Here we are. Futures down 2/10 on the S&P. Coming up a little bit later, Christina Campmany of Invesco. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income and levies on corporations and wealthy Americans. Now, that plan has little chance of passing in Congress now that Republicans control the House. Senate Republican leader Mitch McConnell has been hospitalized after falling Wednesday night in Washington. An aide said McConnell tripped during a private dinner. No word on how badly he was hurt. McConnell is 81. He was elected to the Senate in 1984. The UK plans to relax some data protection requirements under the European Union law. The bill includes reforms that would make it easier for British companies to mine user data and research and development. Businesses have cautiously welcomed that move. Privacy groups, though, are critical. Crypto-friendly Silvergate Capital plans to wind down operations and liquidate its bank. Silvergate collapsed amid scrutiny from regulators into dealing with fallen crypto giants, FTX and Alameda Research. The bank sold off assets at a loss and shut its flagship payments network. And Credit Suisse has delayed publication of its annual report after last-minute questions from U.S. regulators. The Swiss bank was due to publish the report today, but the SEC had questions about revisions Credit Suisse made to previous cash flow statements. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
With a 200,000 plus people, you have a normal turnover rate. It's starting to go down to an all-time low again. The reality is you can manage that head count. And so we're redeploying people across the franchise, including investment bankers to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our head count peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Bank of America is not Credit Suisse. That was Brian Moynihan, the Bank of America chairman and CEO, catching up with Francine Lacqua. Credit Suisse wishes it was Bank of America at the moment. B of A is doing okay. Credit Suisse, anything but this year. The stock is down another 5% in early trading, down 5% to 253. And here's the latest, that Credit Suisse has delayed the publication of its annual report and compensation details for 2022 after US regulators raised last-minute technical queries, Tom, on previous statements. Just a tricky time. We're down about 8% over the last 3 days.
Excuse me, I'm coughing, gasping out loud, waiting for the jobs report. I think, John, that this is the measurement of different assets, and then from the measurement of those assets, appropriate ratios of some form of coverage. And in the murk we're in, they have to clarify how they measured those assets. That would be my truly amateur take.
Yeah, I don't know, but I do know it's been a tough week for this company. Started out the week with David Harrow of Harris Associates, longtime shareholder, one of the biggest shareholders of the bank, backing away and standing at stake completely, and essentially communicating through the media, through the Financial Times over the weekend, that there's just better opportunities in European banks right now. That sector's delivering.
The 3-day chart shows it all. Bring up the 3-day chart if you can. On radio, all you need to know is it is a substantial move, as John mentions, off of the Harris Associates exit, and then the shock of what we've seen this morning as well. Expert on this is Jan Patrick Barnard. He's in Frankfurt with us with some serious financial cred as well as his journalism. What is the urgency this afternoon in Zurich, Jan Patrick?
No, I bet it's pretty high, and I guess the urgency in Zurich is on a high alert level for the better part of the last year, I would say. So, I mean, here we are again. The bank really struggles to get anything right at this point. It's like bad headline after bad headline, and that's reflected in the stock price, as you pointed out. I mean, if you look at Credit Suisse compared to the European banking sector, you have a performance gap now over the past year of 100 percentage points. I mean, that's just amazing.
I look, Jan Patrick, at the reality in America mostly by what we call perspective. That if a stock goes under $5 per share, many institutions have to sell. Is there a breach at 3 Swiss francs? Or moments ago, almost going through 2.50 Swiss francs, or dare I say it gets to 2? Is there a point where institutions are forced to sell?
Well, there's no point where they are forced to sell in to that degree, but I would say, like we see, and that's part why the share price is so much under pressure, there's very little incentive or very little prospect for any investor to buy Credit Suisse shares at this point, unless you have like a very deep pocket and a very long breath to stay this out. The problem is the bank has done nothing, really nothing, to show investors that they're turning the ship around. So why would you be engaged in that stock except for it being cheap on paper? But the thing is, as it's playing out right now, you don't know. You have to check your ticker every morning. Is there another bad headline coming out? And that's not a foundation, I would say, for an investor to be happy to be in a stock if you from the get-go are like in a state of nervousness and cautiousness. So that makes no sense.
Let's build on that, Jan Patrick. Earlier this morning, John asked the question, is there any good news that we keep getting or that we have gotten from Credit Suisse? Is there any good news that perhaps has been drowned out by the litany of bad headlines?
Well, I would say, like, in general, I mean, they're trying, right? I mean, like, they have a plan in place. The problem is just, like, so far it's not working, right? So if you want to make a buy case for Credit Suisse here, you can say, like, the stock is super cheap. A lot of the bad news is certainly priced in. And now all they need to do is just, like, turn it around, produce some good headlines, show us that the financials are going into the right direction, that they stop the outflows. It sounds easy, but it's probably not for Credit Suisse right now, because, like, think about, like, the day-to-day business. Right now, all the relationship managers have again called their clients and explained to them what's going on, instead of like going after new clients and building business and building relationships. So that keeps them occupied, and that will then feed through to the financials. So and that the bank is just busy with itself and can't really like focus on their core business, so to speak.
Jan Patrick, I'd love to dig a little into the allegations here. This idea that the SEC raised some concerns about previous financial reports that they said weren't going to necessarily get refiled. What's the more unusual aspect about it? The SEC disclosure, or that they delayed an annual report, which is usually on time?
Well, I would say this is both highly unusual, and it shows you like the core issue at Credit Suisse. I would guess like if something like that, some technicality or whatever it is, happens with another bank, it's a good thing that the regulator is asking questions, but would they force the bank to delay the report? Maybe not, right? And that shows you that Credit Suisse is in such a dangerous state, I would say, like that the regulators are very nervous, and that they are extra cautious with everything that Credit Suisse is doing. And of course, if I would be a regulator and a bank that is not in good shape is like starting to change the numbers, I have some questions too. So it makes total sense, but it is highly unusual.
Jan Patrick, you used an important word there. You said dangerous. What's dangerous about it?
Well, I would say, like as I said before, like banking is a business of trust, and especially for Credit Suisse, and they're losing it day by day with all those headlines and all those issues that they are producing, and the share price goes lower and lower, and at some point, I'm not sure if capital becomes an issue again, but think about if they have, like in the course of this year or the next 18 months, have to go to the market again and again ask for fresh capital. It would be horrible, and I think that is the big danger for Credit Suisse here, that they really fail to turn this around. They're losing money, they burn through capital, and then you never know what's happened if you find enough investors again that are happy to jump in there.
Well, these aren't conversations we have lightly, but are you suggesting they face some kind of existential risk?
Well, that's a tough question to ask, and I mean, like, I want to give them credit that they're at least trying and to turn the ship around. And I mean, it's still a 10 billion franc bank, so it's a major institution. And I guess, like, before we really get to the existential question, a lot of other things have to go wrong. But the problem is, like, the trend and the dynamics right now are very dangerous, and they have to, at some point, they really have to do something forceful to turn this around, just to avoid this discussion at all costs. Because, like, the existential thing with a bank does not start when it's actually there. It starts when people talking about this, and we saw this with Deutsche Bank at some point when they were in bad shape. So Credit Suisse has to do everything they can to produce some good headlines, to produce some good financial data over the next couple of months and quarters to get people not even thinking and talking about that problem.
Well, let's hope that's soon, for their sake. Jan Patrick Barner, thank you, sir, of Bloomberg on the latest with Credit Suisse. The beleaguered bank down another 8% year to date. On the session, it's down 5%. The problem with Credit Suisse right now is this is happening against the backdrop of where European banks are doing pretty decently. We're talking about 30 points of underperformance here. You've got the Euro stocks banking sector right now, Tom, up 22% year to date. At the same time, Credit Suisse is down on the year.
The way I'm looking at this is there was a day where Jamie Dimon had to stand outside the front door of Bear Stearns, like, you know, down Park Avenue. John, you go down there. Lisa runs down there after the show just to see what's going on. And the American banking system dealt with a huge challenge with Bear Stearns. I'm not equating this to Bear Stearns, but I'm absolutely baffled, as John Patrick nailed, the Chinese water torture of this. I just don't get it.
Well, part of it is because it's not Bear Stearns, because there isn't that systemic risk, because it hasn't been a capital issue, because there haven't been this sort of systematic connections, that connectivity that's been sort of beaten out of the system after 2008. So that kind of has prolonged this for even further than it otherwise would have been, and raises the question, well, how long can they just subsist, even with all the negative headlines, if they've got some capital, they've got some backers, and they have some income?
The big challenge, and I mentioned it just in terms of what David Harrow of Harris Associates said, people will see better opportunities elsewhere, and arguably that's what's been happening over the last couple of months. It's not just the water torture of the drip, drip, drip of bad news. It's the fact that you've got some good news elsewhere. That's the real game changer.
So Sunday, March 16th, 2008, they fixed it. They said, Mr. Diamond, walk across the street to Bear Stearns and get this solved. They've got UBS in town. What are they waiting for is what I don't get.
But to your point, who wants to go in when you've got alternatives, right? You have the Middle East, that you've got Middle Eastern investors that are saying,
yes,
we can use Credit Suisse and we can go and we can invest so that they can be our bank. And then how much does that kind of discourage other capital for coming in if people are looking for control for very specific reasons that don't have to do with returns that you get potentially from some of the financial
That's a point really well made, Lisa.
Their equity on the Bloomberg terminal. Are you ready?
Sure.
I've never seen this. 4.5%. They are 95.5% debt. I've never seen that. That's how bizarre this is.
This stock right now, 253 on Credit Suisse. Up next on this program, Christy Muller-Glissman, the Managing Director and Portfolio Strategist over at Goldman Sachs from New York. This is Bloomberg.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
We're in data that is really having trouble sending us a clear signal.
The adjustment we've seen in markets has been quite small, given the news that we have from Powell.
It's important that he laid out just how data dependent they are and the willingness to pivot.
The Fed talks too much. I have thought that throughout this whole cycle. There's too much talking, too much talk of disinflation.
If we are going to consider re-accelerating to 50 based on the data, and they are very data dependent, the risk of a hard landing does go up.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative about 0.2%. A little bit later this morning, jobless claims in America. Then, Tom, it's on to payrolls Friday. And I think we're all asking the same question. Just how low is that bar for a 50 basis point hike from this Fed after testimony from Chairman Powell?
To me, it's revision Thursday and into revision Friday. To me, the revisions, as I said yesterday, John, is everything out there. They've never been more important in the narratives. Can I just say, John, that this show is forever scarred by you. It's your fault.
What's happened?
We're going to show opening, folks, and we talk right up to the opening, and Bramo's talking about Verstappen.
I know.
I mean, that's how bad we've descended down the rabbit hole.
I won't go any further about what
Please,
we've talked about.
thank you. I appreciate that. Some discretion. Thanks. Let's talk about rates.
Whenever Tom says, let's talk about what we talked about in the break, I think everyone's sitting there nervously.
Is Verstappen with the Bundesbank? I can't remember.
No, but if he was, he'd be asking for higher interest rates, no doubt.
Good segue. Love it.
Don't you think? He's on board with everyone else. He's got lots of savings, Tom. I'm going to whip through the price action. We're not even going to have an opening conversation this hour. Futures negative 0.2% on the S&P. You've heard from Chairman Powell for 2 days. That's all over with. Slight walk back on day 2.
Slight, yes.
Some ifs, some buts. Ultimately, the maybe comes down to the economic data. It's payrolls tomorrow. It's CPI on the 14th, Tom, and then the Fed on the 22nd.
VIX 19.46. I know that all the adults tell me the VIX right now is not giving me good information. You know what? It's there, and equities have sort of kind of like been immovable given the fixed income narrative, the economics narrative of the last 48 hours.
Lisa, the 10-year just in and around 4% right now.
Let's see how the narrative shifts in perhaps a half an hour or perhaps an hour. We get the data dump that includes challenger job cuts at 7:30 a.m. One of these peripheral types of measures that take on new importance in the era of data dependency. Initial jobless claims come at 8:30 a.m. Do we get a sense of the ongoing strength that we got yesterday from the JOLTS data? You can look at some of the quits rates for possible softening, but the bottom line is 1.9 job openings for every unemployed American, close to the all-time high record of just north of 2 jobs per every unemployed American. This is unsustainably hot for a Federal Reserve that has not seen the progress that they're looking for. Perhaps we'll get more on that from 10 a.m. We get Fed Vice Chair for Supervision, Michael Barr. He will be speaking about crypto. Perhaps we'll also talk about what we heard from Jay Powell, 50 basis points, what the threshold looks like. And in related central bank speak, it is the last meeting for Governor Kuroda over the Bank of Japan tonight. His term ends on April 8th, and this a lot of people are looking for to get a sense of, A, whether he wants to open the door to potentially moving away from the yield curve controller or widening the band even at a time when the 10-year Japanese government bond keeps trading above it. And today, President Biden will be releasing his campaign speech or his budget proposal, whichever one you want to say. It's going to include a host of tax increases, including a 25% minimum tax on billionaires, as well as eliminating that carried interest tax break, a number of other proposals that a lot of people say are dead in the water. It will be interesting, though, to see, again, the contours of the debate raising the debt limit, or basically how do you deal with the debt ceiling, given the fact that basically you either have to cut your benefits or you have to raise revenues, one or the other, and it's clear which side he's taken, John.
Dead on arrival is in pretty much every single headline in the United States this morning. Lisa, thanks for that, Tom. That seems to be the headline.
We have a jewel, the Congressional Budget Office. It will analyze those proposals. I'm sure they'll be told by a GOP member at gunpoint, you've got to analyze those 4 items. But the answer is, You can look at the analysis and be a fear. The heart of the matter is, John, are we growthy enough to handle our debt? That has changed in the last 6 months with this new higher interest rate.
I think the chairman was pretty clear in testimony over the last couple of days. The growth of the debt in this country is unsustainable.
I mean, I'll be honest, in the IMF meetings in April, I'm reading a lot about this, getting up to speed in this new world. It's a new world for Washington.
It's a whole new world.
After all.
Thank you, Tom. Christian Muller-Glissman, Managing Director
It's like a
for
song.
Portfolio Strategy
It's better than
at
Evan
Goldman
Costello.
Sachs. We're not going to start singing, Christian, don't worry. Let's talk about how low that bar is for 50 from this Federal Reserve. What would we need Friday morning, tomorrow, and on CPI day next week?
Yeah, I mean, listen, I think it's all about the trend, and the Fed wants to see a downtrend that's convincing. I think we had this blockbuster print last time, so there is going to be a downtrend. How much? I think consensus is looking for 200,000 or so. I think we're at 250 on payroll, so we're a bit above. I think, is that enough to push the Fed to 50? I think you need to put it in context with the inflation data, with the average hourly earnings. We're actually expecting the average hourly earnings to be a bit more moderate, in line with consensus. We're a bit above on the inflation side as well. But our economists actually kept the 25 bips. And I think they feel like it's making sense for Powell to open the door to 50, but to step up after you step down, I think that is still a significant step. So the question is really if there's, some type of blockbuster surprise to the upside that can get them there. I think with the current data set, our economists kept the 25.
Christian, let's go to Tony, and you did this at the Warwick Business School years ago where John attended. Christian, I'm going to look at your phrase, macro momentum. I think this is incredibly important physics envy of the mass of the system, the velocity of the system, which leads to an immovable macro momentum. What is the macro momentum right now?
Yeah, I mean, like the challenge is, exactly as you said, the momentum is actually really good. I mean, you've had the PMIs, new orders over inventories. A lot of the leading components are confirming what markets have been pricing now for 2 months or so, which is that the global economy is kind of accelerating actually, and the US is not decelerating as much as anticipated. So the momentum is positive, and we've taken the credit for that already. That's the big problem. You mentioned it, the VIX is kind of 18, 19, 20. If you compare that to the MOVE index, the type of rates volatility we're currently generating, it tells you like the market already discounts that better growth, because otherwise equities would have suffered just like last year from the rates volatility. So my sense is growth momentum is very good. The challenge is that where we are in the cycle, to your statement with regards to state variables, we're still late. We still have unemployment very low, inflation very high, risk premia very low. That just creates a bit of a tension between momentum and where you are.
I was looking at your allocation as you look at this mess that we all are looking at and trying to understand where we're going. And it says that your neutral equities and credit underweight bonds, overweight cash, and commodities. Underweight bonds. How counter consensus is that, and why?
Yeah, I mean, listen, I think, as you know, like our view has been that rates volatility over the course of the year is fading, no? Because you have peak inflation, central banks are closer to the end of their tightening cycles. And now we have this new burst of rates volatility because inflation is stickier, there's reacceleration risk, and we need to get through that. In this process, we have to be clear, we're quite advanced. The market has repriced the peak rate for the Fed, for the ECB, and it looks much more symmetric. We've kept the underweight at this juncture. We've had the underweight for a few weeks now because we feel like it's a hedge for the portfolio. In case there is really this type of blockbuster data that scares the market. And a lot of conversations we currently have with clients evolve around maybe monetary policy is not as effective anymore in tightening financial conditions and possibly getting demand under control. If that narrative gains traction, you could easily overshoot